The committee will come to order without objection. The chair is authorized to declare a recess of the committee at any time. This hearing is for the purpose of receiving the annual testimony of the chairperson of the Financial Stability Oversight Council. And I'll recognize myself for 5 minutes to give an opening statement. When Democrats first passed the Dodd-Frank Act, they claimed the Financial Stability Oversight Council was one of its crown jewels. FSOC, whose agency heads largely failed in the last crisis, would now be able to clearly identify risk to financial stability and take action before these emerging threats metastasized into another crisis. But a fatal flaw in this pipe dream was always the failure, perhaps the deliberate refusal, of Dodd-Frank's supporters to recognize that among the greatest threats to financial stability are Washington policies themselves, including policies of the very agency heads that sit on the council. FSOC simply refuses to look in the mirror. In its report, it conspicuously omits any references to specific government policies or agencies as helping cause the systemic risk it identifies. Quote, greater risk-taking across the financial system is encouraged by the historically low yield environment, the council reports. Yet the council refuses to identify the obvious source of this apparent risk, one of its own members, the Federal Reserve, and the Fed's unprecedented loose monetary policy. The council warns of reduced liquidity in the capital bond markets, yet never acknowledges that Dodd-Frank's Volcker Rule and other regulations have drastically reduced liquidity. The council lists, quote, risk-taking of large, complex, interconnected financial institutions as a threat. Yet again, it fails to mention that Dodd-Frank amplifies the threat by empowering the council to designate certain firms as too big to fail, thus enshrining the concept into law. These designations will make only worse the profound threat ignored by the council, but recently identified by the Federal Reserve Bank of Richmond in their bailout barometer. That threat being that hardworking taxpayers, implicitly or explicitly, are now on the hook for a staggering 60% of the liabilities of the entire U.S. financial system. The council turns a blind eye to other serious threats. Fannie Mae and Freddie Mac, at the epicenter of the last crisis, barely receive a mention. And it gets worse. Our unsustainable national debt, $18 trillion and counting, as all can see, perhaps one of the greatest existential threats that we face. More debt incurred under this administration than our nation's first 200 years, totally ignored. This is beyond negligent, it is beyond egregious, it is dangerous, and frankly, it is offensive. Another glaring omission from the report is any meaningful reference to economic growth, or rather, the lack of it. Along with Obamacare, Dodd-Frank is at the center of the administration's economic policies. As we approach Dodd-Frank's 5th anniversary, we see the slowest, weakest recovery in the post-war era. We see an economic recovery that has created 12.1 million fewer jobs and has provided $6,175 less income for every citizen compared to the average post-war recovery. Again, compared to the average, we see an economic recovery that has left 1.6 million of our fellow citizens mired in poverty and working middle-income families losing over $11,000 in annual income that rightfully should have been theirs. I find it stunning that in its report, FSOC can find a link between weak economic growth and Greece and stability in the Eurozone, but apparently can find no link between economic growth and stability on this side of the Atlantic. Also nowhere to be found in the Council's report is the threat posed to our stability, growth, and personal freedoms posed by the erosion of the rule of law under this administration. We know that our president seemingly never tires of admonishing us that he has a pen and a phone ready to enact whatever policy he sees fit. Regrettably, he never seems to have handy a copy of the Constitution. As Americans become less governed by the rule of law and more governed by the whims of Washington, fear, doubt, uncertainty, and pessimism are sown. It is not lost on the American people that increasingly Washington decides what credit cards can go in their wallets, what kind of home mortgages they can receive, and whether, if they like their bank account, if they can keep it. Truly, never before in my lifetime has more unchecked, unbridled discretionary power been given to the unaccountable and unelected. This includes the Financial Stability Oversight Council, which operates largely out of public view, yet its decisions have the potential to profoundly alter the lives and livelihoods of every American. FSOC typifies not only the shadow regulatory system, but also the unfair Washington system that Americans have come to loathe. Powerful government administrators, secretive government meetings, arbitrary rules, and unchecked power to punish or reward. Mr. Secretary, your council and the rest of Washington needs to awaken to the obvious truth, and that is when it comes to systemic risk, Washington is a large part of the problem. Now recognize the ranking member for 5 minutes.
Thank you, Mr. Chairman, and welcome back, Secretary Lew. Today we received the annual report of the Financial Stability Oversight Council as required by law. As we all know, this year marks the 5th anniversary of the enactment of the Dodd-Frank Wall Street Reform and Consumer Protection Act. It's hard to believe it was just 5 years ago that we were coming to grips with the magnitude of the financial crisis, which caused the greatest loss of wealth in a generation. All told, the financial crisis cost our nation more than $13 trillion in economic growth and $16 trillion in household wealth, not to mention the devastation of an unemployment rate topping 10% in many states. In the lead up to the crisis, nobody in the private sector or in government was looking at the stability of our financial system as a whole. Nobody was looking at the big picture, and nobody had the responsibility to deal with emerging threats before they caused damage to our economy. That is why we created the Financial Stability Oversight Council as part of Dodd-Frank. FSOC filled that void, looking at every aspect of our financial system for possible weaknesses, and it serves as an advance warning system to identify and address systemic risks posed by large, complex companies, products, and activities before they threaten the economy. The Council has ensured for the first time that our financial regulators are working collaboratively to identify and respond to emerging threats to financial stability. And with their February announcement outlining enhanced engagement and opportunities for public input, they have doubled their efforts to engage with the industry and Congress in a transparent manner. In its 2015 annual report, the FSOC noted substantial progress to protect Americans from another crisis. And indeed, we have taken important steps to prevent another economic disaster from happening, including making our large banks more resilient through stronger capital, leverage, and liquidity standards, covering oversight gaps in our financial system by designating complex, interconnected non-banks for consolidated supervision, and reforming key markets like asset-backed securities and money market mutual funds. However, 5 years after Dodd-Frank became law, my Republican colleagues remain fighting the battles of the past. They continue to believe that if only we roll back all of the rules of the road, the financial system would magically unlock growth and the market would suddenly police itself. And they continue to ignore the lessons of the last crisis by doing all they can to undermine FSOC under the guise of oversight. By focusing merely on dismantling Dodd-Frank, my colleagues on the other side of the aisle impede Congress's ability to focus on the new, emerging threats to financial stability identified in FSOC's 2015 annual report. Like the Consumer Financial Protection Bureau, destroying FSOC has become a leading component of the Republican deregulatory agenda. And while they waste countless hours working to undermine it, engines of job growth and American competitiveness, like the Export-Import Bank, face a possible shutdown in just 5 legislative days. Rather than renew a proven job creator like the Ex-Im Bank, Republicans are spending their time bogging the FSOC down in countless document requests and inquiries, an obvious effort to undercut its ability to protect homeowners, consumers, and the American economy. So, welcome, Secretary Lew, and thank you for your resilience in the face of efforts to stop the Council from its important work. I look forward to your insight on areas of systemic risks the Council has identified and hope to learn more about what EFSOC is currently doing to monitor for such risk and promote financial stability. As we hear additional details from you, I will be interested to hear whether Republicans believe EFSOC should take any action to address systemic risks or simply wait for another crisis. So I thank you, and I yield back the balance of my time.
Gentlelady yields back. Today we welcome the testimony of the Honorable Jack Lew, Secretary of Treasury. Secretary Lew has testified before our committee on previous occasions, so I feel he needs no further introduction. Welcome, Mr. Secretary. We are happy to have you back. Without objection, your written statement will be made a part of the record. Mr. Secretary, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Chairman Hensarling, Ranking Member Waters, members of the committee, thank you for having me today and for this opportunity to testify on the Financial Stability Oversight Council's 2015 annual report. I'd like to begin by recognizing that we're a few short weeks away from the 5-year anniversary of the enactment of Wall Street reform and the creation of the Council. As we approach this milestone, it's clear that these reforms have made the financial system safer and more resilient while supporting long-term economic growth. Wall Street reform has put important consumer, investor, and taxpayer protections in place, supporting companies that play by the rules and serve their customers, small businesses that need access to credit to grow and create jobs, and working men and women trying to save for their children's education, a down payment on a home, or their own retirement. Wall Street reform has worked. 5 years ago, the Council was created to be a forum for the entire financial regulatory community to come together to look across the U.S. financial system to identify and respond to potential threats to financial stability. Today, the Council is doing exactly what Congress designed it to do, from asking the tough questions that will make our financial system safer to shining a light on emerging threats before they can evolve into the next financial crisis. Moreover, the Council's members' agencies work collaboratively to leverage the expertise that each regulatory agency brings to the table. And the Council has also established a track record of conducting its work in an open-minded and deliberative manner, incorporating constructive suggestions from stakeholders, including members of this committee, that have made the Council more effective. The Council asks hard questions and only makes judgments based on facts and detailed analysis. Before discussing this year's report, I want to emphasize why each annual report is important. The annual report provides transparency about the Council's work. Each report covers a range of issues based on extensive data-driven analysis. And it contains in one place the collective views of the financial regulatory community about current risks and emerging threats to financial stability, along with recommendations for specific actions to mitigate those risks. The findings and recommendations set down a marker for action, providing clarity regarding the Council's priorities and a roadmap for the year ahead. This provides Congress and the public a way to hold the Council accountable for making progress. The report highlights the Council's recent work and demonstrates its continued commitment to openness and good governance. For example, this year's report highlights a series of important Council initiatives over the past year, including enhancements to the Council's transparency policy, stronger internal governance, supplemental guidance to our non-bank designations process, and ongoing engagement with the public regarding potential risks from asset management products and activities. Last month at our 51st meeting, the Council released its 5th annual report. This year's report focuses on 11 key areas, many of which have been discussed by the Council in prior annual reports as well as at its meetings over the past year. These include the potential incentives for greater risk-taking in a low-yield environment, the need for continued progress to reform benchmark rates such as LIBOR, and the continued reliance on short-term wholesale funding. For each of these areas, the report highlights where progress has been made and where more still needs to be done. Cybersecurity remains a key area of focus for the Council. The financial sector has been a leader of other industries adopting cybersecurity measures, but still we have seen cyber incidents affect the largest financial institutions and the community banks that form the bedrock of the financial system. That's why this administration and the Council are focusing on how to continue working with the private sector to strengthen best practices, information sharing, and incident response. I commend the committee for focusing on the topic in recent hearings, and we look forward to working with Congress on this critical issue. This year's report also identifies several new potential risks coming into focus, which the Council and its member agencies will monitor over the coming year. For example, the Council will pay heightened attention to ongoing regulatory efforts to bolster the resiliency of central counterparties, or CCPs. The Council also highlighted the ongoing evolution of market structure across various asset classes and the need for constant monitoring to ensure that markets function efficiently. The Council recommends continued vigilance to the confluence of factors driving changes in market structure and the extent of their impact on market functioning and the provision of liquidity. Promoting financial stability and protecting the American public from the next financial crisis should be a common objective that we all support. Yet opponents of reform continue to advocate rolling back these protections, including the ability of the Council and its member agencies to respond to future threats to financial stability. As the Council's annual report demonstrates, threats to financial stability are real and will evolve with the marketplace. We simply cannot let our guard down. I want to thank the other members of the Council and all the staff involved with the 2015 annual report for their hard work and commitment. As we approach the 5-year anniversary of Wall Street reform, we will continue to work with this committee to continue addressing these threats and promoting the strength and stability of the U.S. financial system. Thank you very much, and I look forward to answering any questions that you have.
Thank you, Mr. Secretary. The Chair now yields himself 5 minutes for questions. Mr. Secretary, I alluded to it in my opening statement, but by chance are you familiar with the Bailout Barometer report of the Richmond Fed? Are you familiar with this report?
I've seen it in the past. I'm not sure which one you're holding.
I'm sorry?
I've seen it in the past. I'm not familiar with what you're holding.
Okay, so you have reviewed the document. You're familiar with the report?
I'm familiar with the existing
Okay, so you're
document.
familiar with the fact that it indicates that there's been a 61% increase in the explicit federal guarantees in our financial system since the crisis. Is that correct?
I understand that that's the analysis that's in that piece of paper. I haven't read the piece of paper.
Okay, do you have any reason to challenge that analysis? Has FSOC come up with a contrary analysis?
Look, I think if you look at the experience we've had since the financial crisis, since financial reform, we have seen...
No, I'm just asking, Mr. Secretary, has the
I
Council
haven't looked at that piece of analysis.
Okay,
really
okay,
quick.
that's...
I can give you my response to the idea, but that's what I was...
Okay, well, let me quote from the report. There's $26 trillion, according to the Richmond Fed, in explicit and implicit federal backstop today. The report, one of the final conclusions of the report is that, quote, it is essential to restoring market discipline and achieving financial stability to shrink this federal safety net. Do you agree or disagree with their conclusion?
I don't want to comment on a report I haven't read. I'm happy to address the issue, Mr. Chairman.
Okay, well, how about their conclusion? Do you believe, independent of their report, that it is important to achieving financial stability to shrink the size of the government federal safety net? In our financial markets, is it important or not important?
I think if you look at the financial stability situation today versus before the Dodd-Frank Act and Wall Street reform, we have
Mr.
a much
Secretary,
more system.
I'd be happy to let you have some context, but I would like for the question to be answered. It's a fairly
I'm
simple
happy to read
question.
it.
Do you believe that for the sake of financial stability, that the extent of the federal safety net in our financial markets should be shrunk?
I think if you look at an issue that we have talked about before, I very much believe that it would be a good thing to enact a reform in the area of GSEs. There was progress on that on a bipartisan basis in the Senate last year. It's something that didn't proceed to the floor.
So can I take your answer as yes?
No, Mr. Chairman, I'm happy to look at that report. I'm happy to offer my views on this issue. But
you don't have to look at the report, Mr. Secretary. I'm just asking you about a conclusion.
Yeah,
I don't sense I'm going to get an answer. Let me move on, Mr. Secretary. So
I'd be delighted to answer the question if you give me the time.
Well, I think you've had plenty of time to answer the question, Mr.
I don't think I've gotten
Secretary,
a
and you
second
haven't. Under Dodd-Frank, FSOC is comprised of agency heads as opposed to the agencies themselves, correct? We can both agree on that?
Yes.
Okay. And we can also agree that of the 10 voting members of FSOC, each was appointed by President Obama, correct?
Yes, I believe that's correct.
Okay, I alluded to it again in my opening statement. I have read excerpts of this report. I have not read the entirety of the 150-page report. Have you read the entire report?
I have.
Okay, good. Then my staff read the entirety of the report. I've read many excerpts. So in identifying emerging threats to financial stability, can you point to any page in the report where FSOC identifies a current federal policy or rule as a contributing factor to an emerging threat? Because we can't find it.
So, Mr. Chairman, we identified the threats that we see as real. Many of those have a connection to federal policy. I'm happy to answer specific
Okay, but under Dodd-Frank, you also have the mandate to actually make recommendations. So how do you make a recommendation if you can't cite a source?
It is not my view that federal regulation is a significant risk to financial stability. So I don't
last
agree
time
with
you
your
were here,
premise.
Mr. Secretary, there was increasing evidence that we are suffering great illiquidity in our corporate bond market. You admitted that. This report cites it. We know that when mid-market companies hoard cash, they can't promote jobs and economic growth. Many economists believe this will be the source of the next financial crisis. Somehow the FINRA head can connect this bond illiquidity to the Volcker Rule. SEC Commissioner Dan Gallagher has said the Volcker Rule has set the stage for a potentially dire liquidity crisis. Similar testimony from CFTC Commissioner John Carlo. Even former Secretary of Treasury Larry Summers has said, quote, there's a danger in their enthusiasm for keeping each individual institution safe that regulatory authorities will lose sight of keeping markets open and liquid, and I think that is a legitimate concern. So in your last testimony, you found no evidence that the Volcker Rule contributed to bond illiquidity. We have incredible evidence that it is. Do you still stand by your previous testimony that there is no connection to bond illiquidity in the Volcker Rule?
Mr. Chairman, I think that the question of market liquidity is a very complicated one, and trying to reduce it to one factor is never going to produce.
I said a contributing factor, Mr. Secretary. Is it a contributing factor?
If you would allow me to answer your question, this is a complicated issue. It's a very important issue. It's an issue that I spend a lot of time thinking about. It's not a 10-second answer. I'll give you a thoughtful answer.
Starting out with, is it a contributing factor? Is it
answer.
not a contributing factor?
Yeah, I think that it is not possible to say what is the single cause. I do not believe that federal regulation is a significant factor.
Secretary. My time has expired. I now recognize.
May I just ask to address this issue, because I think it's actually a very important issue.
Mr. Chairman.
I'd be happy to have the Secretary answer the question. Please, the Secretary is recognized.
Mr. Chairman, I think if you look at the question of liquidity, there are a lot of people trying to reach a simple explanation to a complicated question. We are at a point in the business cycle where we are seeing naturally a lot of volatility as we move out of the deepest recession since the Great Depression. We're seeing an expectation of some movement in interest rates. That is a significant factor. We're seeing the market structure changing rapidly. We're seeing the introduction of a high level of electronic trading, including high-frequency trading, that's changing the structure of markets. We've also seen a tremendous increase in the volume of issuance of bonds. That's having a big effect on market structure.
I understand all that, Mr.
I think anyone who tries to point to a single thing, like a rule,
Secretary, I did not say it was a single thing. I asked you the question, was the Volcker Rule a contributing factor? And several minutes later, you have still refused to answer the question. My only takeaway is that you don't see it as a contributing factor in so many other market participants.
I think that part of the issue, there was a desire in financial reform for certain things that are high-risk, highly leveraged investments to be less liquid. I don't think that's necessarily a bad thing. That doesn't mean it's a good thing for there to be a loss of market liquidity. I do not see a major impact in terms of broad liquidity, but we are constantly looking at this question of liquidity, and we're open to asking the question as to what the impact of federal policy is. I just think it's a mistake to start there.
You could have fooled me, Mr. Secretary. I now recognize the ranking member for 5 minutes.
Thank you very much, Mr. Chairman. Mr. Secretary, I'd like to offer you the courtesy of continuing your explanation if you would like to have it.
Thank you very much, Congressman Waters. I guess the thing I would add is, that there's been a lot of focus on this issue since October 15th, and there's been a lot of telling of the story of what happened on October 15th that is just not based on the analysis or the facts. There was no breakdown in Treasury markets on October 15th. That's not something that's supported, but there was no liquidity crisis. There was a moment, there was a blip, there were a lot of things going on, but we don't see any evidence that regulation contributed to that event. There was a moment in time when there was a lot of off-risk sentiment because of events going on in the world. There was a huge amount of electronic trading going on, and there was a blip in the market that obviously is very much worthy of our attention. But people took from that, I think incorrectly, the notion that somehow that was an event that was caused by a rule. It wasn't. And we're doing a lot of work on it and look forward to issuing an analysis very shortly.
Thank you, Mr. Secretary. One of the largest and most frequent criticisms by my Republican colleagues have lodged against the Financial Stability Oversight Council is what they deem to be a lack of transparency with respect to non-bank systemically important financial institution or SIFI designations. And while I think many of their criticisms are merely attempts to hamstring the council under the guise of oversight, I do appreciate that you and your staff have redoubled your efforts to engage with Congress and with non-bank institutions and to open up your deliberations for additional public scrutiny. Mr. Secretary, would you describe precisely what changes to both the annual and to the 5-year designation processes that FSOC made in its February 2015 supplemental procedures announcement? And please also describe how FSOC balances the need for transparency against the need to protect sensitive market and supervisory information.
Congressman, thank you. We made a number of changes that were designed to respond to concerns raised both by this committee, members of the committee, and by stakeholders, which give a great deal earlier notice and transparency to the process to parties that are under review. I want to just underscore that there was a lot of back and forth even before. So this is not as radical a change as it may sound like, but it is more formal, and I think it is something that has led to a good deal of kind of recognition that the system is more transparent, which is our goal. The review process, by necessity, involves reviewing highly confidential business documents that are commercially sensitive. But under law, we have to protect the documents and the information. We try our best in the context of that constraint, which is a reasonable constraint. It's a constraint shared by supervisors of these institutions as well, to be transparent with the public and the committee at the same time. I think that the changes that we've made have helped, but FSOC is a young organization, and we remain open to suggestions on how to always improve the process.
Last month, the chairman of the full committee and 5 chairmen of each subcommittee sent a lengthy and onerous request for documents regarding the FSOC designation process, which contained at least 13 different subparts. It is my understanding that more than a week ago, you responded to that document request with an offer for in-camera review of 1,400 pages of confidential business and bank supervisory information. Since you responded, my staff has begun to review a review of those materials. To your knowledge, has the majority availed themselves of that opportunity? And would you consider the production of such sensitive and voluminous documents to be consistent with the Council's desire to be transparent with the Congress?
Congresswoman, we did make that offer. We appreciate that your staff has begun reviewing it. Unless it's happened in the last day, I'm not aware that the majority has reviewed it, but it could have happened in the last 24 hours. That's the right way for us to make clear the commitment to transparency while protecting very sensitive confidential information.
Thank you very much. And members on this side of the aisle, would you please allow the Secretary to answer questions and give him the courtesy of not badgering him? This is complicated subject matter that we're dealing with, and he deserves the right to be able to respond in the time that it takes. I yield back the balance of my time.
Time of the gentlelady has expired. The chair now recognizes the gentleman from New Jersey, Mr. Garrett.
I thank the chair. So, Mr. Chairman, you said at the outset, I would be delighted to answer your questions if you just give me the time. Well, you know, Mr. Secretary, we gave you the time to answer some questions that were submitted to you after the last hearing, which was back in March. And lo and behold, it took your appearance here today before we got the answers of them. In other words, at 11:18 last night, we get the answers. That's March, April, May, and now halfway through June. So we give you a lot of time, but it's just a pattern, I guess, of this administration of ducking the questions and evading the answers, and it's certainly a pattern of yours of obfuscation in all these things and not giving a clear answer. You know, you have such disdain for the American public that we have to bring you before this committee before you would simply answer the American public's question. You know, Mr. Chairman, you asked a question, is it a factor, the Volcker rule, and the Secretary couldn't answer it. And yet, Mr. Secretary, you were able to come up with a litany of other factors. You said it was a factor with regard to the time that was happening. High-frequency trading was a factor. Volume was a factor. So you ran off all those, correct? That those were all factors. But then did you say that regulation and Volcker is not a factor? Is that the final answer?
Congressman, what I said, it's complicated, and we are open.
It's quite complicated. I understand it. And you listed the other 4 factors. All we want is a simple question. You did say that in the blip, there was no evidence of regulation being a factor in that blip, correct?
That's certainly my understanding.
Okay. So is it your understanding further going forward that Volcker, therefore, is not a factor in any of this?
Congressman, I think the Volcker rule is a very important protection
Is it a factor?
Against risk-taking. I can't
You
give you...
gave us 4 other factors. Is this one of the factors?
Congressman, I listed the factors that I know are very much real.
You know whether this one is a factor.
I am not able to say that I know the Volcker rule is a factor.
So you knew the other factors and you don't know this factors. That's the end of those questions.
I'm trying to demonstrate an open-mindedness that you're not giving me a chance to express.
No, you
I haven't ruled out that anything
answer the
could
question,
be a
Mr.
factor.
Secretary. Reclaiming my time. With regard to the FSOC and the FSB, I appreciate that the FSOC has announced that it has a process with regard to the listing of the potential risk associated in going forward in the designations. Is there such a process with FSB as far as a due process system in place there that we are trying to get to with FSOC?
Congressman, the FSB is a very different process than
I understand
FSOC.
that.
There is no consequence to the designation.
I understand that.
So it doesn't have the powers that FSOC. Only FSOC has the power to impose a regulatory burden on.
So is there a process, nonetheless, of due process for the companies that would?
There is an open process where stakeholders share their views, and certainly governmental entities share their views with the FSB. But it's a different kind of a process. So I don't think the same kinds of due process issues apply when you're not designating a firm with the consequences.
So it's not a due process, it's a different process, is what you're saying?
Well, I'm saying you're comparing apples and oranges. FSB and FSOC are very different. So there's an appropriate set of due process concerns.
So within that process right now, the FSOC is asserting its authority with regard to new roles with the disclosures of asset managers and the like, and I'm sure you're familiar with that.
Yes.
And I know the FSOC had previously been looking at that issue. Until SEC finalizes that, will you go to FSB and suggest that they make no final determination with the asset managers?
So, Congressman, I think there's a more basic issue, which is that we are having...
I'm not asking the basic issue. I'm asking the one question.
I don't think the FSB's process and our process are at all identical.
I understand that.
We
You
have
just
our
said that.
own
So
responsibility.
what I'm asking you is, as a member of SSB, where you said, you've told us repeatedly it's done on a consensus basis, I'm asking, when you go back and try to get a consensus, will you say, as your position is, until your regulator, the SEC, which is working on this, you would ask FSB to stand down for now until this decision is made over here?
So what we're doing at the FSB is trying to make sure that it's a thorough, complete review. They're
Gotcha.
proceeding in a
I
similar
gotcha.
manner
I
that we are.
understand all that. You're
looking at
being
the
thorough, diplomatic, and all the rest. Simple question. Until SEC finishes their process, will you use your capacity to say that FSB should stand down in this area? That's a simple yes or no question, too.
I don't know the precise schedule at the FSB, so I
didn't think
can't-
that you did. I'm just asking, would you assert your
I
authority?
don't think that the FSB can time all of its actions.
I doubt that they
around
can,
what
but
we do.
can you assert your authority in that regard to try to do so?
Look, this consensus process, let's understand what it's about. It's about trying
No, I'm
to
not trying to
drive
get the
the world
consensus process.
to the
I'm trying to
highest
ask you whether
standard
you will
possible.
use your authority as an American
I don't know.
Secretary
I would
Treasurer
have-
to
I would have-
represent the American companies on their behalf.
I would have to look at where we were and where they were and make a judgment at the time.
Yeah, well,
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Mr. Secretary, we have held a number of cybersecurity hearings this year, both in this committee and in the Small Business Committee, to examine the toll of cyber attacks on consumers and businesses. Many of the witnesses stated a clear, uniform set of rules was needed to address this problem. Can you elaborate on FSOC's proposal for a national plan to respond to cyber threats that you mentioned in your testimony?
Thank you, Congresswoman. This is a hugely important issue in every sector of our economy and our country because truly there are exposures to cyber risk everywhere. The financial sector, I think, has been a leader in taking it seriously, and the largest firms are putting enormous resources into trying to put systems in place that are effective. One of the things that we've done as a government that I think is very important is our National Institute of Standards, NIST, has put out best practices. We have encouraged the private sector to use best practices. I've certainly encouraged other financial regulators to have the same view. I think that we're at a kind of a moment where it's not just a question of what does a firm do itself, but you have to ask, what are the policies a firm has with regard to who it will do business with? A lot of the exposures come not directly at the firm, but when a third party connects to the firm.
Right.
So those firms not just have to worry about what are they doing, but do they have good standards as to who they will do business with? And our goal ought to be to bring all of those parties to the highest standard. I think it's premature to talk about having a single national standard that's mandatory. We've put it out as a voluntary standard. I think many are going and using that standard, and I think it's something we have to continue to look at.
And cost is an issue, especially for small businesses. And do you have any type of interagency working relationship on this matter, like SBA, Small Business Administration?
We do work across agencies in many areas. In particular, there are connections between, say, the utility sector and the financial sector, because if your power goes out, you're obviously going to face a risk. I'm not familiar with what the SBA's program on this is. In the financial area, one of the things that we focused on is the need for smaller financial institutions to be able to work together or through organizations so that they can pursue best practices together, because the burden for any individual firm would be too high. That's one of the reasons it's so important to have legislation in this area to make the collaboration between firms easier and less risky for them. We've been very much supporting the enactment of cyber legislation, but even pending the enactment, we've put out executive orders to try and pave a way for firms to work together.
Thank you. As you mentioned, lending standards have decreased as financial institutions try to find profitability in the current low interest rate environment. While the loosening of credit markets since the recession is beneficial for small businesses, too much risk-taking could again lead to problems. If interest rates were to rise, What impact will this have on the markets overall and specifically on access to capital for small businesses?
Congresswoman, I think that there's at some point a trade-off between access to credit and risk-taking. We have raised concerns over the last couple of years that in some cases there may be an over-adjustment where you look at the FICO scores for home mortgages, the averages have gotten very high. There are a lot of not very risky potential borrowers who are having access to credit issues. Some of that requires a clarification of some of the policies put in place. It's why some of the agencies have been addressing the issue like putback risk. Now, why am I answering a question about small business lending with housing issues? I think we all know for a lot of small businesses, the pathway to credit in part is through their personal home equity, their home mortgages. So the two are related. We've done a lot through our programs to reach out, both through the SBA and through programs we at Treasury run to make credit available to small businesses. We work with the community banks and local lenders to encourage that lending. I think it's an important question. I do think as we come out of through the financial crisis into a period of calmer macroeconomic circumstances, that's an important time for more lending activity to be appropriate. The question isn't do financial institutions have no risk? Do they take reasonable risks, and are they not overly leveraged?
Thank you.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Missouri, Mr. Lukenmeyer, for 5 minutes.
Thank you, Mr. Chairman, and good morning, Mr. Liu. I was kind of taken back by your report. This morning in the Washington Times, there's a report that CBO put out, I think, yesterday. I don't know if you've seen the article yet with regards to...
I haven't seen the article. I know the report.
Okay, thank you. And, they put in, they make comment here that, the headline, CBO warns of financial death spiral from debt. First line says, rising federal debt threatens to choke off economic growth within a decade, beginning a death spiral that will sap revenue from government programs even as demand grows, forcing the government to borrow even more. And one of the things that, in your testimony here, your second paragraph, the first line says, the Council was created to identify and respond to vulnerabilities in the U.S. financial system and provide a mechanism for agencies to talk to each other and take collective responsibility for addressing potential threats to financial stability. And yet, in your report, I don't see anything about debt. Am I missing something?
Congressman, I think if you look at the risks to our economy from federal spending and debt, we are in a much better position now than we were 6.5 years ago. We've reduced the deficit as a percentage of GDP and in dollars at a historically quick rate. And that very report makes clear that over the next 10 years, we're in a pretty stable place. I think the thing in that report that people are concerned about is the long term. And obviously, there are still long-term issues.
Mr. Secretary, that's not what it says here. It says the long-term outlook for the federal budget has worsened dramatically.
No, I said over the next 10 years. That report goes out far longer than 10 years. And I think that the issue of...
So we're got just a little blip in the screen here, and then we go back a little lower part of the curve, and then we go back up again?
I think if you look at where we were in 2008, 2009, we were careening towards a very treacherous place. We've stabilized it, and it's improving. We still have long-term challenges.
Mr. Secretary, if you just quote the president and use his analogy of a car in the ditch, we're not out of the ditch yet. We're still trying to struggle out, get out of there. We're bumping along here with annual growth rate of what, less than 2%, 1%, something like that of our GDP. And here CBO says, and the point I'm trying to make is, CBO points out the debt is a problem for our economy. And yet your report does nothing, says nothing about it, and you are supposed to be an agency that points out these problems. Why, is my question is, why did you not point out that debt is a problem for our economy?
Our report appropriately looks at the threats to financial stability.
So you don't consider it a threat?
I think that if you look at where we are today versus 6 years ago, The federal deficit has been brought under control for the next decade. We're in a period where we need to get the economy growing. I totally agree with you. Our conversation should be about what can we do to grow the economy. And we know there are things we could do. We could have an infrastructure program in place. We could have immigration reform. There's lots of things we could do to grow our economy.
Oh.
I don't think right now the debt 20, 30 years from now is the thing that's holding our economy back.
I think you've missed the boat, quite frankly. CBO points it out. Nothing in here. I think we're missing the boat. We've dropped the ball on this. Next question. One of the concerns I have as the chairman of the Housing and Insurance Committee, we've got a situation where we have designated some insurance companies as SIFIs. And one of the things that's fine if you feel there's that much risk there. We've asked before, quite frankly, to give us the criteria on which you based your analysis, and we've never gotten it. We had his undersecretary that's here not too long ago, actually did a very good job of giving us analysis on this. But I think part of your job also is to figure out how to de-risk things. Okay, you pointed out there's a problem. Okay, how do we get the problem solved? And I think that's also what is in your report, is in your first line here. It talks about for addressing potential threats and to find ways to get back to financial stability. So how do we de-risk do we have criteria in place yet to de-risk a SIFI, an insurance SIFI?
The analysis that led to firms being designated is laid out clearly in the record that's quite public, and I think each of the firms understands why they were designated. The question of how they, you're really asking how could they exit, because de-risking would mean they would no longer be. We've made clear that we are going to review regularly, annually, with the status of the firms. We've done that with the firms that have been designated, and if a firm changes its business model and has less risk, it would no longer be designated.
I see my time is up. I'll yield back. Thank you, Mr. Chairman.
Time of the gentleman has expired. The chair now recognizes the gentleman from New York, Mr. Meeks.
Thank you, Mr. Chairman. Mr. Secretary, I want to go somewhere else, but I just got to say, I think from what you were talking about, how we're better off than we were 6 years ago, and I wish my colleagues had, talked about the person and when they had the opportunity to stop the person that drove the car into the ditch in the first place that caused us to have this debt and all this problem. So then when someone else comes along, they say, okay, I'm going to help you get out of this ditch that I didn't drive you in, but I'm going to get you out of the ditch now. And you start pushing them to get them out of the ditch. Now, you might not be going at 100 miles an hour yet. You're going maybe at 50. But now you're no longer in that ditch. You're out of the ditch, and you're moving in the right direction. But yet you want to blame the person that is getting you out of the ditch instead of the one that put you in the ditch in the first place. And that's where we are today. We were in a ditch in 2008, and now we're driving ourselves out of the ditch. That is where we are today. Let me go to where I really want to go to, Mr. Secretary. Dealing with asset management. And that's what I've been looking at, dealing with FSOC and the work around asset management in that industry. And I know they don't, assume all of the risk as banks, so we look at them differently. But I did see in one of the reports, however, and I'm concerned about herding. I think that was in an FSOC report, an OFR, et cetera, and we have, a lot of investments there. Should we be concerned about this process of herding?
Congressman, I think that obviously asset management has grown as a sector, and there's a lot of individual and institutional assets there. We've been looking carefully at this question for some time. The risks are not necessarily just firm specific. That's one of the reasons that we're looking across the industry at activities to ask, are there activities that are particularly risky? We have not reached a conclusion. I'm reluctant to give a view until we've reached a conclusion because, frankly, we've entered the process, as have regulators around the world, trying to understand and learn about a growing and somewhat new industry. We've identified that as a question. I can't prejudge what the answer is. What I can tell you is that it is important that we complete the process and that it be driven by facts and by analysis. And if there's action that needs to be taken, the appropriate regulatory body should do so. I think the notion that you cut these questions off because you think you might not like the answer or because you think you know the answer is exactly what got us into trouble in 2007 and 2008. We have to be willing to ask the questions, and even if the answers end up being hard, follow them to a logical, analytic conclusion. I think that's what FSOC is doing, and I look forward to that process being completed.
So let me, and I know on some in municipal levels and state levels where we have multi-billion-dollar pension plans that have tried to benefit from a greater diversification of asset managers by using more emerging and diverse asset managers, which are generally smaller asset managers, and some are minority and women who, have selective investment strategies. However, I'm finding that these small managers face real barriers that prevent them from gaining more market shares. Has the Treasury or FSOC looked into how we can get more diversification of managers in this industry?
Well, I don't know that FSOC has looked at it. As Treasury Secretary, I've looked at it, and I think that if you look at the performance of the smaller and minority-owned managers, there's not a huge difference. Some are successful, some are not. The same is true with the large managers. Some are successful, some are not. Some have good years, some have bad years. I think one of the problems is that there's a tendency to bulk things up because it's easier to deal with a few rather than a lot of managers. And we need to push back on that. We need to make it clear that the door has to be open to new participants in this space. And we've tried through a number of things we've done to have that be the approach, both in terms of how we've managed some things within Treasury and through other intergovernmental efforts we've had. I think we're making progress, but there's more progress that needs to be made.
Okay, because, as these asset managers get bigger and bigger, they play more and more of an important role in the sourcing capital to business that create jobs in various communities. And so, that's one of the reasons why with banks we had to go to the Community Reinvestment Act in the 70s. So don't you think we should be looking into some policy that can ensure that we have more inclusion in the asset management industry so that we can also make sure that they're investing or reinvesting in some of our other communities?
I think it's important for there to be broad participation and for the process to be open. I don't know that I would think you should have kind of mandatory targets. But I'd be happy to follow up with you, and it's a matter I have a great deal of interest in.
Time of the gentleman has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, chairman of our Monetary Policy and Trade Subcommittee.
Right over here, Mr. Liu, Secretary Liu. Yep.
Everybody's moved around. I don't know where to look.
Sorry about that. So, unfortunately, I've got 5 minutes, not 15 minutes, so I'm going to try and quickly and respectfully move through a number of things. I, too, received the email at 11:18 last night in answer to my questions on a few things from 3 months ago. Congratulations. You were actually very clear on one of my questions regarding financial services trade negotiations. I asked for you to explain why Treasury continues to oppose including financial regulatory matters in TTIP. This is the most clear answer that I think I'm aware of and I think the committee has seen. You say TTIP is not, however, an appropriate or necessary vehicle for addressing financial regulatory cooperation. You claim that it's already happening in Financial Stability Board, international standard-setting bodies, and a number of others. I disagree with the answer. I think it should be included in, but I appreciate your clarity. But it does lead me to another question, which is having to do with local storage data requirements that many in Europe are starting to push. And it's my understanding the administration has highlighted the free flow of information across the digital world as a sort of a centerpiece of the negotiations for both TPP and TTIP, which is, again, a provision I fully support. I'm confused as to what that difference without a distinction might be as to why you are going to be doing that, since it makes tremendous amount of sense to have us negotiate with our partners in this, if it's bad for American business. But again, you exclude financial services. And I'm curious, is it the administration's position that we're seeking to prohibit local storage requirements for everything except for financial services?
No, we've been very firm on the issue of putting non-tariff barriers in place where you have a local storage requirement for electronic data. I think the distinction is easy to make, and I have tried to be clear in this committee before. We view prudential regulation as something that ought not to be brought under trade negotiation or trade process, and that's the difference. It's not prudential regulation to say that there shouldn't be a non-tariff.
So you're willing to have the financial services sector treated differently than any other sector of the U.S. economy?
Well,
in these negotiations?
in general, trade agreements do not bring prudential matters or health and
we've
safety.
got the Europeans. I mean, in this,
we've said no to the Europeans on this.
well, yeah, the Europeans would like to do it,
Yeah.
and it seems very odd and I think a huge mistake. Secondly, I do want to quickly move on to the IMF and Greece. Would you agree or acknowledge that the decision to bend the rules, shall we say, if not ignore the rules, regarding Greece on the exceptional access framework, which was done with Treasury's concurrence, was a mistake?
Look, I think that the actions taken in 2010, 2012 to avoid an economic crisis in Greece were the right thing for the IMF
So
and
it was
the right
not a
thing
mistake?
for the United States.
Okay, but so just so I'm clear, it wasn't a mistake.
At the time,
Okay,
Greek
so
debt.
now, looking back, do you think it was a mistake?
No, if I could just take
I'll take
Yeah.
no, because I'll take no as your answer. That's fine. Because there is a discussion of putting those rules back in place at the IMF. That is something that the IMF board is interested in, and I'm curious why the administration, from my understanding, is opposed to that. Why?
Look, I think that there's occasions when it would be important for the IMF to have flexibility.
So the rest of the IMF board, excluding us, wants to put those rules back in place because they believe that it was a mistake of what happened with Greece. But
So I think that's not exactly where the conversation in the IMF is. There is a serious
I've
conversation.
had a number of conversations with folks from the IMF and involved with the IMF, and I'm not sure that that's an accurate portrayal.
So, Congressman, there's a range of issues, and I think it's important to distinguish them. There's the exceptional access issue itself, and there's a question of how to proceed into a new world of debt reprofiling. We've tried to separate.
We also have the temporary new arrangements to borrow, and I know that the administration's been trying to use that as a reason to not necessarily go into IMF quota reform. But it seems to me if we're not going to address this exceptional access framework,
So, Congressman, if I could just take, I know you're running out of time, but if I could just take a half a minute to respond.
I'm happy to take a private meeting later about
I'd be
it.
delighted
We
to.
can only get you up here twice a year.
This is a hugely important issue. Obviously, quota reform is critical to the U.S. place in the world, and we're working very hard to get quota reform enacted. I think exceptional access has serious questions. I have never pushed back on the kinds of questions you're asking, and I'm open to a serious conversation about it. I think looking forward, finding a way for the IMF to avoid having to use tools like that is in all of our interests, and I'd be happy to have a conversation.
Time of the gentleman has expired. Chair now recognizes the gentleman from Massachusetts, Mr. Capuano.
Thank you, Mr. Chairman. Hello, Mr. Secretary. How you doing? You familiar with Major League Baseball?
I've heard of it.
You familiar with the team called the Boston Red Sox?
I have.
So you purport to be an expert in baseball. Well, Mr. Secretary, can you tell me what's wrong with the Red Sox right now?
That's a long...
No, that you refuse to answer that question. I need to know. Is it the pitching? Is it the fielding? Is it the hitting? Come on, Mr. Secretary, answer the question. I can't believe you refuse. If you won't answer that question, can you answer me why the Republican baseball team can't seem to beat the Democrats? Come on, Mr. Secretary, answer the question. You got plenty of time. Oh, well, okay. If you refuse to answer the question, I guess I'll have to move on to some other areas. Because I just wanted to show that I guess badgering is not the exclusive realm of some of my colleagues. We can badger too, but it doesn't produce much. So,
As a Mets fan, I'm showing great self-control, though.
Mr. Secretary, for everybody's sake, in your next FSOC report, can you put a chapter in there on debt? You got a great story to tell. I think my colleagues actually raise a good point. I mean, debt, in theory, could be a risk to the economy. and you have a good story to tell, it would satisfy everyone, including me.
I understand, and look, we could discuss it and say why we don't think it's a risk. The report focuses on the things that we think are risks, and
But I
it's a
think
fair
that-
point.
Yeah, just, if you do it the next time, at least you take one of their arguing points away, and you make some good points. And I think it's a fair thing to discuss. With that, I am going to move on to a couple of things that, not directly related to FSOC, but indirectly related to it. First of all, I'd like to talk about Fannie and Freddie. Has Fannie and Freddie paid back every penny of the money that they borrowed from the American taxpayer?
They have, I believe,
The answer is yes.
I believe the answer is yes, but
I know it is. I'm asking a question I know the answer to. And by the way, haven't they also paid back billions upon billions of dollars above what they borrowed?
yeah. I think I understand where you're going, Congressman.
Hope so.
And I think what they have not done is they've not removed from the federal government, the federal taxpayer, the risk that goes with those institutions having the backing of a federal backstop.
That I understand that, but the money that they're paying now, above and beyond the money they borrow, where does that money go?
It goes to the Treasury.
Goes to the general treasury. So basically, homeowners that have a
So,
mortgage.
so does the risk, the support that goes behind the risk.
I
is the Treasury
supported all that. I'm not-
and federal taxpayers.
I totally agree with everything that was done up until they paid back their loans. My problem is they paid it back, they're stable, they're heading in the right direction, and it's time to get back to more business as usual because, like everybody else, I want to keep homeowners keeping their own money to the best of our ability. Yes, there are interest rates, and yes, there are some risk, but they're dollar-for-dollar risk. Right now, they're simply contributing to the Federal Reserve, to the General Treasury account, and that doesn't seem fair to me. It strikes me that if we're going to have a General Treasury account, either we should tell people we're charging you extra because you have a service, or we're increasing your taxes, neither one of which are sins to me. But in this case, you're charging them through their mortgage for something that is unnecessary at this point in time.
That's not the way I look at it. I see it, the GSEs are still in conservatorship, which means the federal taxpayer is directly standing behind them if they fail in the future.
Well, they've done that from day one, and you weren't
Well,
taking money from
no,
mortgage.
from day one, there was an actual denial that there was a backstop. It's now clear there
Who
is a
denied
backstop.
that?
It was in law.
Well, I would respectfully and strongly disagree, and I think facts pointed out that I was
No,
right.
and I think that we've seen over the last several years, the estimates of the potential risk of a problem in the GSEs is still quite large. So
I understand, but if the money were going to a separate account to sit there and build up some kind of capital reserve, I think you'd have a fair argument.
But the
Well,
liability
money going to
is
the General
borne
Treasury
generally.
doesn't bear up in my estimation. This
the liability
money
is borne
investors put
generally.
in.
Yeah.
Number one, they deserve their money back now that they're stable. Number two, homeowners deserve lower interest rates unless they're being told what the money's used for. And right now, some of their money is being used to support something other than Fannie and Freddie. So I guess we'll have to disagree on that. And I guess with the last few seconds, I wanted to follow with something that I brought up with Mr. McCraith, whom I think is also doing a great job. However, it strikes me that that FIO and possibly FSOC is pursuing a backdoor way to take over regulation of U.S. insurance companies via international agreement. Now, that may be a little overstatement, and I'm not a black helicopter guy, so I kind of overstated it to make the point. But it certainly strikes me that some of the agreements we're about to make with some of our international friends may be pushing a little too far. With that, I'll have to yield.
Time of the gentleman has expired. The chair now recognizes the gentleman from Wisconsin, Mr. Duffy, Chairman of our Oversight Investigations Subcommittee.
Thank you, Mr. Chairman. Welcome, Mr. Liu. Obviously, you are the Treasury Secretary, not the coach of the Red Sox, and therefore we're not going to ask you questions about their failings. We would note that they're doing better than the Brewers, which says a lot about the Brewers. But if you were the coach, we'd expect you to answer the questions that we have about baseball. And when we ask questions, we hope that you wouldn't give us answers about the history of baseball and how it came to be, and you could talk about the history of Fenway. You would actually answer the questions of what's wrong with the Red Sox. And you had a lot of questions today about the liquidity in the bond market. And I think the chairman brought out, is this related to Volcker? Or other rules and regulations that have caused banks and traditional market makers to leave the space. And I want to give you a chance to answer that question. Is this something that you're looking at? Do you think the rules and regulations that have come since the crisis have had any part in the lack of liquidity in the bond market?
Well, Congressman, I think that to answer the question fully would take quite a long time because it's a very complicated issue. And
Red Sox are complicated too.
And I had tried to indicate that we are open to looking at any of the possible causes.
We're not playing. This is not a got-you game at all. You identify risk in the markets, right? That's your job. And you do come in and you've talked about cyber and you've talked about other things that are very complicated that we can't wrap our heads around, but you tell us where you see those risks. And so it's a very simple question, because a lot of the commentators will say, listen, it is complicated. There's a lot of reasons why there's a lack of liquidity in the bond market, but they will unanimously point to one of the causes could be the new regulatory regime and its impact. So can you, the commentators can talk about this, but you're not willing to answer that question today?
In fairness, Congressman, I'm offering a much more detailed answer than the commentators. Most of the commentators that I've heard, with some self-interest, have jumped to one explanation.
You do this you do this really well. So I ask you about liquidity in the bond market, and I mentioned commentators, and then you'll start to talk to me about commentators and the history of commentating and the articles that are written. Are you unwilling to answer this question? Because the do-gooders who are looking for risk are actually the ones that are potentially creating the risk in the market. And so if you tell us, yes, this could be a cause of the lack of liquidity in the bond market, you have to look at yourself. You have to look at the regulatory regime that's taken place since the financial crisis, and you don't want to admit that today. And that's not badgering. I think that's a fair question. And to say that it's too complicated to answer, man, I don't understand that, Mr. Liu. Just give us a straight up shot. What is it? Yes or no?
I think that if you look at the many factors that are at work right now that are having an impact on liquidity, it's not my view that financial regulation is the principal thing that requires our attention. I have not said we shouldn't look at it, and I think these other factors are very clear.
I don't know if you were a tap dancer when you were young. I didn't ask if it was the principal. This goes back to what the chairman was saying. You're playing with words. Is it a contributing factor? Which goes back to the point that the chairman made. Is it a contributing factor, the rules and regulations? Are you looking at that as a contributing factor, not the main factor, not the only factor, but a contributing factor? Yes or no?
If you look at liquidity, you have to look at different parts of the market.
I know.
And if you're looking at treasuries, it's different than if you're looking at high-risk bonds.
I'm going to ask you a yes or no question. Are you looking at FSOC, yes or no, at whether the rules and regulations are having some impact on the lack of liquidity in the bond market?
We're looking at all factors that could
contribute. So you are looking at that.
We're looking at all factors that could contribute.
So this is one.
I'm saying that as Secretary of the Treasury, and it's something that many of the members of FSOC and their own agencies are looking at as well.
This isn't complicated stuff. We ask you simple questions, and I think we're entitled to get straight answers from you. And I think if you think, listen, the rules and regulations that come have no impact. The commentators are wrong. Banks and market makers have left the space, but that has no direct correlation with the lack of liquidity. Tell us that.
Congressman, I think that the financial reform has made our system safer and sounder than it was. We have a stronger economy because of it. Liquidity is still deep.
Is it creating a risk too?
And I think that when we look at the issues related to liquidity, we should look at all potential factors. I identified the things that I'm
quick
aware
question.
of.
Do you support TPA like the President?
I do, very strongly.
Duly noted. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney.
Thank you so much, Mr. Chairman, and I am very pleased to welcome one of the favorite sons of the great city of New York. Very good to see you, and I regret I had to chair another meeting, and I just got here, but I want to follow up with something that was raised by Ranking Member Waters earlier, and while my good friends on the other side of the aisle have criticized FSOC for not being responsive to their document request, I'd like to point out that FSOC did make 1,400 pages of confidential documents available to this committee. And my staff, and I believe the staffs of many others on this side of the aisle, have been over there to Treasury and reviewed these documents. And these were confidential documents laying out the detailed reasoning behind the FSOC's decision to designate individual companies as systemically important, which was exactly what the majority asked for. So I think supplying 1,400 documents for review is being responsive, and I just want to make that very, very clear. Now, I would like to ask you, Mr. Treasury, you said earlier that the issue of bond market liquidity is a legitimate one, but we should be very careful about assessing the causes of the lack of liquidity. And I agree with you. I don't think we have any definitive answers yet, but I think it's an incredibly important issue. I think it's also important to focus on potential problems in the Treasury market rather than other markets, because the Treasury market is a $12 trillion market that determines the borrowing cost in so many other key markets as well. You mentioned the huge swing in the Treasury market on October 15th of last year and said that there was no evidence of a breakdown in the market that day. And I agree. I agree with you. On October 15, trading was continuous and trading volume was heavy. So was it really a lack of liquidity driving the wild price swings, or was it something else? So can you give us some more context for what the FSOC has found so far as it has looked into this issue?
Thank you, Congresswoman. We have worked at Treasury together with other agencies that look at the market carefully and tried to follow the transactions that day to understand what actually happened. And there was a huge amount of volume. And there was this 15-minute period when there was a price spike. But it was not, there was not a breakdown in the market. It's something we have to ask what happened then and what do we learn from it going forward. There was a huge amount of electronic trading going on. Market structure has evolved, and one of the things with technology is you never go back, so we have to deal with the reality, and there's many positive things about electronic trading, so I don't say that critical of the development of electronic trading, but that changes the structure of a market. We're looking at that. I can't sit here today and say I have a clear answer. We're hoping over the course of the next few weeks to complete our analysis so that we can offer a more definitive view. But what I was trying to say before is that there was a desire to jump to a conclusion that somehow financial reform caused October 15th. We see no link between financial reform and what happened on October 15th. Maybe others will find it. But it's why we have to be so careful when we ask these questions about liquidity to treat a very complicated issue the way it should be treated. I have not ruled out looking at any of the contributory possibilities from any policy area or market condition. But we also ought not to jump to a conclusion, which many did very quickly in a way that I can understand why they did, but it doesn't mean it's right. And the Treasury market remains the deepest and most liquid in the world. There are other areas of the market where there are some questions about liquidity that are quite legitimate, where they're not electronically traded, so that is different, where the huge volume of corporate bond issuances raises some questions about would there be a good liquid market if there were a very stressed day. We're looking at all those questions. We take them very seriously. One of the things, you got to separate the different kinds of liquidity, because if it's a question of institutions keeping high-risk proprietary investments on their balance sheet or not, that is not something we should go back to. We have a system that's safer and sounder because we've moved away from that.
Well, thank you, and I look forward to your report, and I hope you'll personally brief members of Congress.
I would look forward to it.
I think it's critically important, and my time has expired. Thank you very much.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Pennsylvania, Mr. Fitzpatrick, chair of our Terrorism Task Force.
Thank you, Chairman, and thank you, Secretary, for your time here. We've had a couple of hearings of the Terror Task Force to investigate terrorism financing, and I've a series of questions here which I would like to sort of make part of the record rather than go through them today.
Sure.
And ask that the Secretary give us a timely
Happy to
response.
respond.
I'll submit them to the Chair. I actually wanted to follow up on some questions and your quick responses from my friend Mr. Capuano of Massachusetts with respect to the national debt. It was being referred to as the national debt, which is not in the FSOC report's not even identified, that the number one, the national debt is a good story. It's a good story to tell about the national debt. And number two, it's not a threat to our economy. And I think that you answered both in the affirmative. You agree with that?
Look, again, it's a complicated question. I think the national debt, I was OMB director 3 years with a surplus. I believe in having a fiscal policy that lasts for the long term. I think if you look at what we inherited, the stability that we now have is a world of improvement, and there's still work to do 30, 40 years
Mr. Secretary, the question is the debt itself, which in 2008, then President Obama referred to as a $10 trillion national debt is unpatriotic and immoral. Today, there's a debt clock. It's right above us at the hearing. 18 trillion, 159 billion, 11.
But it's going up
$1 million a minute.
It has come down.
Is it a good story?
It is a good story. The deficit has come down as a percentage of GDP faster than any other point.
That deficit started coming down. There was a new administration, new speaker that took office in January of 2011, and because of fiscal restraint of federal spending and growth of the economy, the annual operating deficit is coming down, but it's not zero yet, and the national debt continues to rise. Is that a good story?
I don't think it would be good for our economy if we were to have a balanced budget today. Right now, we have an economy which many of you have said isn't growing fast enough. We need to continue to look at keeping the economy growing and keeping an eye on the long term. Having a stable fiscal posture for 10 years is huge progress.
Mr. Secretary, a couple of years ago, the then chairman of the Joint Chiefs of Staff described the national debt as the greatest threat to our national security. Is an $18 trillion debt a threat to our national economy?
At the time, our deficit was in double digits. It's now coming below 3% of GDP.
I'm not asking about the annual operating deficit. I'm asking about the national debt.
The debt as a percentage of GDP has stabilized for this period of time. We have made enormous progress. It was climbing, and it has stabilized.
Mr. Secretary, last month you referred to a proposed amendment to combat currency manipulation in the Trans-Pacific Partnership as a poison pill. But also last month, the President said he was open to new efforts to combat currency manipulation abroad. Can you describe what efforts or what ideas the administration might have, what the role of Treasury would be, and whether you think they could be effective?
The President and I personally take this extremely seriously. We put an enormous effort through our multilateral and bilateral engagements to use the tools we have, and we've had considerable success. We have helped push China into a different policy and Japan into a different policy. So I think we're using the tools, and we're using the tools well. In the trade legislation that is moving through Congress, there are additional tools. One is that there is a negotiating instruction that says in TPP, currency issues are a high priority, and we're working with our TPP negotiating partners to arrive at agreements that will give us more visibility and more ability to use the consultative process and the public disclosure to get them to do the right thing.
But can you identify the ideas the administration was referring to last month?
Well, and then I was going to say there's an amendment that we support that Senator Hatch and Senator Bennett put in the Senate, which puts new tools in place, which requires that we do an evaluation based on objective criteria as to whether or not countries are violating what we would consider fair currency practices. If they are in violation, it puts us in a position where there's several new tools, including not being able to be in trade negotiations with countries that are violating. So I think we have important new tools in the trade
Finally, I
legislation.
want to get to a question on the budget, Treasury's budget, which the President identifies the budget as a compilation of our nation's priorities. FinCEN and OTFI have been relatively flat funded. Congress has met, probably even exceeded the President's request, specifically on FinCEN. I want to say that the organizations within the Department of Treasury do an outstanding job with the resources that they have. But we see terror growing, the challenges globally every single day, new organizations coming to light every single month. What can you tell us about?
Congressman, I couldn't be prouder of our offices that work on threat financing.
Do they have sufficient resources?
They do have sufficient resources, and they punch way above their weight. But if we thought we needed more resources to do the job, we would ask for them.
Time of the gentleman has expired. The chair now recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman. First of all, I think you're doing a great job, Mr. Secretary. I know we had a disagreement last week on TPA, but I have never, in my time knowing you, have ever heard you address Congress or or the American people with disdain. That is something not in your makeup or character. And
reverence would be more like it.
That's right. That's right. And a desire to serve. So I appreciate that. You're a good man. We don't always agree, but I honestly believe you have the best interest of the American people at heart. And the administration is lucky to have you. I want to focus on a situation here. When a bank is convicted of a felony, or a bank pleads guilty to a felony, we have laws in place. Congress has put forth some laws that says when they're guilty of these crimes, we remove some privileges that they have. One of those privileges that they have is that of a well-known issuer, a WIXI, well-known issuer, and so well-known seasoned issuer. And so we had a recent bout of guilty pleas by big banks, both in connection with LIBOR and also with the FX manipulation of dollar-euro exchange rates. So normally those banks should be penalized by removing that WIXI designation, which allows them, off-the-shelf registration and other privileges. But what's happened is that I believe the Secretary of Labor, Perez, is the one that grants these waivers. I'll give you, for instance, in the latest round of SEC waivers, Barclays just received their third WIXI waiver since 2007. Citigroup has triggered a disqualification 5 times in the last 9 years, and every single time we give them a waiver. We don't penalize them. So there's no difference in how they operate because we give them a waiver after they plead guilty. UBS just received his 7th WIXI waiver since 2008. So they broke the law, criminal conviction, or pled guilty. J.P. Morgan Chase received his 6th WIXI waiver since 2008, and the Royal Bank of Scotland received his 3rd WIXI waiver since 2013. And UBS, going back to UBS, their last WIXI waiver occurred while they were still under a non-prosecution agreement from LIBOR. So they immediately failed. So the penalties that Congress has put in place don't happen because SEC has given them waivers. I'm just wondering if giving these waivers continually and not punishing these banks is a moral hazard, is it causing them to behave just as they always have been? Because it seems that way from me.
Congressman, let me start by saying I think we have made clear as an administration that no individual and no firm is above the law, and we will prosecute and we will enforce, regardless of who has broken the law. Secondly, the violations of law that are behind these actions are very serious. They get to the heart of the integrity of our system, things like tax fraud, things like terrorist financing facilitation. I think that if you look at the prosecutions, if you look at the settlements, the numbers have been very large, and there's no question but that firms have been held accountable.
But the penalty falls on the shareholders. The penalty doesn't go to any of the individuals who were involved here, and these banks continue to operate. Yeah, you're right. There were $2.5 billion in fines, but they just keep on doing what they've been doing. And I have people in my district that are convicted of far smaller crimes, and they do serious time. And so, there's, at least the way is there another set of penalties that we could put in here that you'd actually agree to enforce?
If I could answer your first question, then I'll come back and answer that last question. I think that if you look at the approach that prosecutors have taken, they have wanted to make sure they could hold accountable financial institutions and the individuals in them and not have unintended consequences that they can't control.
But these are intended consequences. That's my point. We intended them to be penalized, and they're not.
And I would leave to the regulators to decide the right way to respond, but prosecutors need to know that they're not going to create an unintended consequence as they proceed.
That's not the point here.
I think on your last question, there are a lot of things we could look at in terms of what the practices within the industry are and how you hold individuals accountable that are worthy of consideration.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Nagelbauer, Chairman of the Financial Institutions Subcommittee.
Thank you, Mr. Chairman. And Secretary Lew, it's good to have you back. I want to refresh your memory a little bit. Back in March, you and I had a conversation a little bit about U.S. regional banks and whether they were systemic risk or not, and also referenced, and you and I discussed a little bit the OFR report in February where they used, I think, 5 of the Basel standards to analyze a number of banks. And if you recall, that analysis showed that $50 billion banks were not a systemic risk. In fact, it went pretty far up the asset chain before it reached a point where they felt like those financial institutions were a systemic risk. Yet Dodd-Frank says that the trigger is $50 billion. And so I guess my question to you as the chairman of the of FSOC, is the framework of Basel in conflict with Dodd-Frank?
I don't think it's a question of in conflict. The question is, do banks of all size pose the same risk and require the same exact treatment? The answer is no. And we have been very careful in designing rules to try and distinguish different levels of treatment for different firms of different size. That doesn't mean we have it perfect. There certainly is an openness to looking at issues there. But I have to say that the debate recently has taken on a kind of odd character. I mean, there has been discussion of exempting banks of $500 billion or less. You know how many banks there are that are between $500 billion and the biggest banks? There's 6 banks. They're amongst the largest financial institutions in the country and the world. So we have to be careful not to ask questions as if a $2 billion bank is like a $50 billion bank, or a $50 billion bank is like a $500 billion bank. And as I would be happy to have this conversation, we are open to ideas of how to tier the treatment appropriately.
Well, and I guess that kind of leads me into the other discussion that you and I had, and that was about Section 115. And I think one of the things is that when Dodd-Frank was passed, and it was passed in a pretty hurried manner and, you know, not in a very transparent manner, but, you know, somebody just picked $50 billion. But then in Section 115, they said, you know what, y'all can establish, gives you the latitude to establish, you know, a different trigger or trigger mechanism if you choose to. And I think if I go back and look at your and my conversation, you said that y'all had not formally looked into it. You mentioned that you had informally looked into it, but there is in fact a process where can be a formal process where the FSOC could go through, Treasury could go through that process and recommend to FSOC to change that. And I'm a little confused.
There could be a formal process, but I think if you look, there are a number of regulators taking a look at this issue to see what they can do with their regulatory flexibility, and I think it's a question of when you raise it to the level of a formal review. I'll give you an example of the kind of issue that we've looked at, the frequency of the examination cycle. There's a reasonable case that the frequency should be different for a small institution and a very large institution. So there are ideas here that could be pursued. The fact that it's not a formal Section 115 review doesn't mean that people aren't asking these questions. If you look within the regulatory bodies, they are looking at them, and we're obviously looking across the landscape.
Yeah, Mr. Secretary, and I think it's important to get their input, but the truth of the matter is under Section 115, those other regulators do not have that authority. Section 115 authority resides in the Secretary of the Treasury, and last I checked, that's you. And so I think it's kind of a little confusing here is that we've got one entity, OFR, you know, using these Basel standards, you know, saying this is what, you know, the world looks like from a systemic risk standpoint. Then we've got Dodd-Frank, and I think from a banking perspective, it's a little confusing as to what standards, you know, should be in place. And I think it's really kind of time for you to take on that leadership role and exercise 115 and bring some certainty to the marketplace.
I'd be happy to continue this conversation with you, Congressman. To be clear, OFR expresses independent views. It doesn't express the views of Treasury or of FSOC. I'm expressing my own views, and they won't always be identical. You wouldn't want them to be identical with OFR because OFR was put in place to be an independent institution expressing its own analytic views.
I see my time has expired, Mr. Chairman.
Gentleman yields back. The chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you, Mr. Chairman. Secretary Lew, good to have you, doing a great job.
Thank you.
I want to keep the conversation for a moment on liquidity. It is a very serious issue. I'm very concerned about it. A number of experts are registering great warnings about it. Liquidity, to me, is the key to protecting our financial system. It's also the key to being able to ascertain potential risks to our system. So it provides us with a way to be able to not just look down the road for problems, but see them before they turn that corner. So I also realize, and I think you would agree, you too are concerned about liquidity, correct? And
I've said so, yeah.
yes, and so the issue becomes, will this liquidity worsen as the economy worsens? And specifically, tell me, what if there were another crisis? We don't want another crisis. After they finished the Depression, they said they didn't want another crisis. But as surely as we have a free enterprise system, it's free to go up, sideways, down, whatever. So if we had another crisis, would the financial system, in your opinion, have the liquidity to be able to come to the assistance of other financial, of our financial system the way it did in 2008, when healthier institutions, it helped us a lot. They had the liquidity. They were able to buy up institutions like IndyMac, Washington Mutual, Countrywide, Lehman Brothers, rather than the government having to wind them down.
So, Congressman, I think when we talk about liquidity in the markets, we're not talking about institutions that merge or don't buy other institutions or not. I think what we're talking about is there a market for buying and selling bonds in a quick way with stable prices? So obviously, the capital and the depth of the balance sheet of institutions will affect potentially both questions, but I think they are severable. Let me make a couple of comments. One, I think that as we come out of the financial crisis, there is undoubtedly going to be some more volatility. You know, I started testifying as Treasury Secretary, everyone was concerned there was no volatility in the market. Now there's a concern that there is volatility in the market. It shouldn't be a surprise that as we see a return to a more normal economy, there's more volatility. I think that the institutions themselves are stronger than they were going into the crisis. They have more of a capacity to come through a period of economic stress in a healthy way, and that's a good thing. And I think in our FSOC report, we look at the risks that we see to the broad financial system, and we do include liquidity on the list, but it is not the single factor that we're looking at. And I think it is also important to separate the different parts of the market, because treasuries are very different from high-risk bonds.
Yeah, let me ask you this other question. I don't have much time, but do you believe that there is any link between our anemic United States growth rate and the fact that our financial institutions have to hold so much capital in reserve rather than putting that capital back into the economic system to good use?
Congressman, I think that there is a lot of money that is on the balance sheet of businesses they don't even need to borrow to get access to, and yet there's a more fundamental question: is why are they not investing more? I think it has to do with a sense of confidence that they're looking for, that the continued economic growth will be strong.
But do you see a link? Is there a causal impact?
I don't think there's a lack of access right now to capital that is the problem. I mean, I focused earlier on things like housing and small business, because I think that's where the questions are real as to whether individuals or small businesses are having trouble accessing capital. Large firms right now are not having trouble accessing capital.
Do you feel that these companies should have to hold as much capital in reserve as they are, and is that helping or damaging?
Look, I think that the fact that our banks now have the ability to see themselves through a difficult period, makes our system safer and sounder. They did not have the capital. They had too much leverage, and we saw in the financial crisis what the result was. We can't go back there.
All right. Thank you, sir.
Time of the gentleman has expired. Chair now recognizes the gentle lady from Missouri, Ms. Wagner.
Thank you, Mr. Chairman. There seems to be so much interest in this issue of liquidity, so I just can't help myself. And perhaps I'll ask a question that will help put this to rest for all of us. In going back to your March 2015 testimony, Secretary Lew, on the issue of liquidity, you said, and I quote, "So I think that this is something that requires a lot of analysis. We're doing it, and I'd be happy to share with you a more complete analysis when we complete it." Now, this was March of 2015. I didn't get anything at 11:18 last night. What's the plan here?
Well, as I've indicated earlier, our hope is in the next few weeks that analysis of October 15th will be completed, and we look forward to sharing it with the committee. It's been a complicated analysis. It's required a number of agencies working with very different bodies of data, and I'm very anxious to have it completed.
Within the next 3 weeks, we will receive...
I can't say that 3 weeks. Over the summer is the schedule we're working on. I hope it's... I've been pressing people very hard to finish it as soon as possible, and as soon as it's finished, we'll share it.
And you believe that that will come this summer, then?
That's the schedule we're working on, yeah. I mean,
and that should answer all of our questions about the importance of liquidity, the lack thereof.
I wouldn't say that any single analysis will answer all the questions. It will help us understand October 15th much better. And in the FSOC report, we noted that there's a broad range of factors. And I must say that I've taken a lot of questions today which want me to comment on regulation. In the FSOC report, we added regulation to the list of things that we need to look at. So we're open to looking at all the causes. I identified the things that I am confident are things that we need to be
I've got several more questions here. We look forward to your report this summer. To date, FSOC has designated 4 non-bank financial companies as systemically important financial institutions, or SIFIs, essentially signaling to market participants that the government considers them too big to fail. As a result, Richmond Fed President Jeffrey Lacker stated that shareholders and creditors of those firms can expect the government to shield them from losses during periods of distress, ultimately putting the taxpayer on the hook for a future potential bailout. For that reason, I'm interested, and I think others on this committee have mentioned this today, I'm interested in how these companies can ultimately de-risk and shed their designation status from FSOC and remove the implicit government support that such a designation carries with it. Knowing that the primary goal for FSOC is to reduce risk in the financial system, I think that you also would share that sentiment. I know that Senator Mark Warner has told you before that there was never any intention of creating a Hotel California, I believe were his words, with the designation process where you were able to check in anytime you like, or pardon me, check out anytime you like, but never leave. Secretary Lew, in the absence of any practical guidance from FSOC on how to exit SIFI designation, is it really possible for designated firms to know what they are supposed to do to reduce systemic risk?
Yes, Congressman. I think that the process is clear, that we review the designations annually. If the business of the designated company has changed and it no longer presents risk, they know what the risks are. We've identified the risks very clearly. And, right now, it's been in the news that GE Capital changed its business plans for reasons that have nothing, I believe, to do with the SIFI designation, but that will cause there to be a review, and we'll have to see whether that changes their character. So we're open to if firms change their structure, if they change their business.
Do they specifically, though, know how they can reduce risk? Have you given them guidance on this?
They know
how to change their business model, their structure.
They know what it is about their business that created the designation in the first place. They know what the transmission
Do they know from
mechanisms are.
you specifically?
There's a very long analysis that goes to the companies when they're designated that identifies for them the basis of determining the risk. If the basis then changes...
So you
the risk
have a list, because I've got limited time here, a list of specific information on what firms can do to remove this designation?
It's not a question of take steps A, B, and C. It's a question of what are the risk factors, and if they no longer...
But you don't
present
have a
those risk
list of how
factors.
these...
The risk factors are quite clear.
The risk factors are quite clear to whom?
To the firms that are designated. They understand what it
Have
is.
you provided them with those risk?
Yeah, it's in the analysis that's available to the public.
I've run out of time, Mr. Chairman.
Time of the gentlelady has expired. The chair now recognizes the gentleman from California, Mr. Sherman.
Mr. Chairman, thank you for holding these hearings. I hope that we get the other members of FSOC to also testify. It's simply, chairman is a lofty position, but if you were to interview the chairman of this committee, I'm not sure you would get the views that would reflect every member. And I'm glad that Secretary Lew is here, but I look forward to hearing from the others. You've got litigation on whether, I guess it's MetLife or perhaps Prudential is a SIFI. You have filed your reasons to dismiss their lawsuit under seal. You're the client. This is a document filed on your behalf. Could you just put it on your website, because it's of public policy interest, of course, redacting any proprietary information about the individual company? Why would the reasons for arguing the dismissal of the lawsuit be under seal?
Congressman, obviously it is a matter under litigation. I'm not going to comment on the substance or the process of pending litigation. We have tried in all of the designations to be as transparent as we can be while protecting legitimate commercial information that we need to protect.
Well, I would hope that you would make that document available for members of this committee, since it's a public policy document as much as anything. Lehman Brothers didn't go under because it had too many assets. Went under because it had too many liabilities, particularly contingent liabilities. And I'm confused as to how there's discussion of mutual funds being listed as SIFIs. Now, obviously, if the markets drop by thousands of points, that's terrible for the economy. It's terrible for me because I've got my individual account. It would be just as terrible if that same money was in a mutual fund. Why would an unleveraged mutual fund be classified with a SIFI, knowing that it has no liabilities?
Congressman, in the review of asset managers, we have made the judgment that the area that we need to spend considerable time on is looking at activities that asset managers engage in and whether or not there's risk associated with those activities. We haven't completed the review yet, so I'm not in a position to
Are you looking at whether the asset management company would go bankrupt, whether the mutual fund would go bankrupt, or whether the economy would suffer not because the SIFI wasn't able to pay its liabilities, but rather because a big company was doing this or that in the stock market?
Look, ultimately, the questions of looking at financial stability involve looking at what the losses would be to creditors and associated businesses, not so much of an issue here. What the run risk would mean in terms of the potential spread to the economy and markets. Whether or not it locks up access to one or another kind of essential services. We are looking not just at firms, we're looking at activities to see whether...
So an entity could be designated a SIFI not because their inability to pay their liabilities would cause a problem, but just because their activities cause a problem.
No, I mean, the question is, are there activities within asset managers that if there were, under a stress situation, a series of bad events. These things don't happen in good situations. They usually happen when there's a lot of bad things going on.
Okay, I want to go on.
And we have to understand, are there activities in those asset management firms that present the kinds of risks we need to be concerned about? I don't know the answer to it. I mean, we've asked this question.
I need to move on to another issue.
We've asked the question knowing that the answer could be yes or no. So I don't sit here today with a firm view.
Yeah. We're, of course, faced with this trade deal. We're told that they're enforceable standards, but they're usually enforceable only if the executive branch of our government is willing to take action. With regard to China currency manipulation, we pass a law requiring the executive branch to do things. You've explained to this committee last time I asked you about it that, well, the law is really bad policy and so will not be followed. If the executive branch won't enforce U.S. laws because our trading partners would find that offensive, it's difficult to see how any provision of any trade agreement would be enforceable if that enforcement required the executive.
The time of the gentleman has expired. The chair now recognizes the gentleman from Oklahoma, Mr. Lucas.
Thank you, Mr. Chairman. Mr. Secretary, good to see you again. In the working order with which we work through members on this side, we've worked through the subcommittee chairman, we've worked through the underclassmen who didn't have a chance to ask you questions last time, and that's appropriate, and now you're back to the old guys on the back row. I share some of the concerns of my colleagues on both sides of the aisle that there's a real problem with this liquidity issue out in the Financial Services Committee. And I find it seems very hard to argue that this reduction in liquidity has nothing to do with the cumulative impact of new rules and regulations and the capital requirements. And while we, of course, continue to work to improve the safety and soundness in the system, it's just as important that we don't lose sight of that big picture, of course, that aggregate impact of all these factors, and be ever mindful of unintendedly creating risk and harming the ability of end users to drive this economy and create growth. I have a particular issue that I'd like to focus on for this moment, though, and that's on the leverage ratio rule as it applies to the treatment of segregated margin. This is an issue that increases cost for end users and impacts their ability to hedge risks. And as you know, Congress required that margin received from customers for cleared derivatives belongs to the customers and should remain segregated from the bank's affiliated members' accounts. However, under the leverage ratio rule, this client margin is treated as something the bank can leverage and treated punitively by requiring higher capital requirements for clearing. If end users don't have the ability to hedge their risk, more risk is introduced into the system, customers pay more, economic growth is harmed, and I think this is an example of the leverage ratio rule and higher capital requirements when applied, I believe inappropriately in my opinion, where it actually harms liquidity and increases risk. As a prudential regulator, can you tell me, why does the rule treat customer margin as something the bank can hedge?
So, Congressman, the leverage rules apply to all assets. It even applies to treasuries and cash. So it's a very inclusive rule. And I think it is reasonable to ask questions as to whether or not there are unintended consequences. Certainly you distinguish it, say, from the Volcker rule. The Volcker rule exempted treasuries. A lot of the questions I got earlier were trying to tie liquidity to the Volcker rule. The Volcker rule obviously doesn't affect treasury holdings. I'd have to look at the specific issues related to
But I hope you would agree it would seem to have the effect, by requiring extra capital to cover these margin accounts that are segregated, it would have the net effect of increasing the cost to the end users. I hope you see where I'm coming from on that.
Yeah, look, as I say, I haven't focused on the margin issue. I have focused on the treasury and the cash issue. And, I think that you go back to the purpose of the leverage rule. It is a very solid objective, which is to make sure institutions don't get overextended. And I think that what the percentage is makes a big difference in terms of whether or not it's the binding constraint or not.
Segregating the money makes very good sense, and I think we did the right thing there. But the net effect, well, let me ask you this then. If regulators have been very focused on removing risk from the banking system through the capital requirements, the additional regulations such as the Volcker Rule. Risk is going to exist somewhere within the system. If we remove it from the banking system, Mr. Secretary, where does it pop up next? If the banks can't play this role of playing a market, somebody will. Will somebody who play that role will it be more of a danger to the overall economy than, for instance, the banks?
You know, I think it is an overstatement to say the banks aren't playing that role. The banks are still doing their core business, and like even under the Volcker Rule, they're not prohibited from market making and holding inventory for market making. I think that you're asking a question that I'm asking as well. With the new the evolution of the markets, are there questions of financial stability that we need to ask that are different? So you look at some of the newer players in the market, where the volume of trading is. I think it does raise questions both about the kind of plumbing of the system, but also about implications on liquidity.
Historically, the banks in making these markets, it would seem to me, historically have had a perspective of evening things out, consistency, stability, being boring. But the entities who are winding up taking their place have historically made their money off of volatility. If we take it away from the people who like to take the wave out, yet give it to people who've made and make more, the more vile, more intense the ways, it just doesn't seem logical.
You know, I think one can overstate the tradition of banks doing things that weren't in their economic interest to maintain markets, but clearly having inventory has been real. I also think that if you look at what the definition of liquidity is, it may not be reasonable to think that there should be no price fluctuation even if there are dramatic things going on.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Cleaver, ranking member of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. Mr. Secretary, thank you for being here. We are moving toward the 5th anniversary of the passage of Dodd-Frank. Many of us were here during those turbulent and troublesome some days, and we know that great care was taken in dealing with the creation of this act, and we think that we made significant progress, and I think you apparently agree with us as well that we have made tremendous progress, and regulators have moved toward implementation. Some of the rulemaking I agree with. Some of it I've, along with my colleagues, have challenged. But overall, we made great progress. But when you think about Dodd-Frank as a whole, what do you think is the most significant thing left undone? What would you want to see right now completed so that we would have the full strength of Dodd-Frank at work preventing another collapse?
That's a very good question. Obviously, there's pieces that need to be completed, and that's not really what you're asking. You're asking what is the kind of area that we haven't addressed?
Yes.
I'd have to say GSE reform is the area we haven't addressed, and it would be a good thing if we would. I'm not sitting here today optimistic that that's going to happen legislatively, but it's why we engaged so much in the Senate in the bipartisan discussion to try and work through an approach to GSE reform.
Mel Watt, who was a member of this committee, I mean, you mentioned the GSE reform, and Mel Watt, of course, is now over at FHFA, and doing a great job. I think some of the work he's doing is going to help in some of the housing needs we have with money put into the Housing Trust Fund. One of the things that you may be able to help me with, what do we do to enable private money to move back into the market?
To the back mortgages?
Yes.
Look, I think that there have been some small steps taken, but there needs to be an active effort to look at what we do to have a more active private securitization industry. The notion that most mortgages are backed by either FHA or a GSE that's backed by the federal government is not a great place for the industry and that part of the market to be. Which is why I said GSE reform, which is a path towards a private, active private marketplace.
But you, I'd say,
the experiments that I think have been useful have been things like putting first loss protection in place apart from the GSE. It's been small, but we've seen that there are ideas there that you can insulate the public from the first risk and start to bring private money back into the place. That can be through mortgage insurance, it can be through capital market products. I think more thought has to be put into that area to develop it further.
but you do believe that there's a need for secondary market?
I'm sorry?
You do believe that we do need a secondary?
Yes, I think it would be good if there were more private, non-governmentally backed.
So the GSEs would be a hybrid?
Yeah, or they have competitors, you know.
I think there's in this committee, there's some suggestion from time to time that the GSEs are not even needed. One of the things that I'm wondering about when some prefer that it be completely private, whether or not the private market, whether you believe the private market has an appetite to fully either take over or, in what I would prefer, re-enter the market.
Look, I think right now the structure of our mortgage industry makes the continued operation of Fannie and Freddie necessary. The idea behind GSE reform was to be able to chart a path where there'd be a different kind of marketplace in the future. So we live in the present. We live in a world with FHA and Fannie and Freddie, and we have to try to make that world better absent legislation.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Royce, chairman of our Foreign Affairs Committee.
Thank you, Mr. Chairman, very much. And for the record, Mr. Secretary, one of my colleagues earlier asked if the GSEs have repaid the money that they've borrowed from the American taxpayer. The simple answer that my colleague tried to elicit, I think, was that the payments they've made to the government now exceed the rescue funds they received. But, Mr. Secretary, I think you agree here, this is not the real answer nor the real question. The real question is, have they repaid their debt to the American taxpayer? And for that answer, I think we can go to the Federal Reserve Bank of New York that was asked that question, and they put it this way. They said, should these figures be interpreted to mean that the Treasury and therefore the taxpayers have been repaid by Fannie Mae and Freddie Mac, and that the two firms should now pay dividends to their regular shareholders again? The answer to that is no. The New York Fed said that taxpayers are entitled to a substantial risk premium. Government support has lowered funding costs and boosted profits, and the government has never collected the commitment fee that the government is owed from Fannie and Freddie. So the false narrative that is perpetuated is that taxpayers have been repaid. It's time to end conservatorship and return the GSEs to control of the shareholders. From your comment earlier, I assume you disagree with this narrative and agree with the conclusion of the Fed that failing to work to wind down the GSEs and give space for private capital to come in would be a colossal missed opportunity to put U.S. residential mortgage finance on a more stable long-term footing.
Yeah, Congressman, I totally agree, and I was trying to indicate in my response earlier that the risk is being borne by taxpayers on an ongoing basis, and the conservatorship is not over. I would only add one additional thing to what I said earlier, which is that the damage done to our economy by the housing crisis was far more than the simple amount of money that was put into the GSEs. And I think Americans are still healing from the pain of that financial crisis. So I think that the right thing is to do GSE reform and to get on to a new restructured system. But it is not the right time to be talking about ending the conservatorship or paying dividends.
And I think we can move forward together on that. I think that on that GSE reform concept, I've publicly endorsed reforms that would increase private sector participation in the secondary housing market, that would decrease taxpayer exposure to future losses and limit disruption to the housing market. But I think if you look at the particulars, more risk sharing is something that can be done to create a lot of space here. A common securitization platform is something that works for the GSEs and then brings in private capital to use that platform. A common residential mortgage-backed security, that would be a good start for Congress, I think, to pass this year, if I could have your thought on that.
Look, I think the items that you just mentioned are the kinds of things we've been talking about and thinking about. Obviously, there is a common security platform being built. It's something that could be expanded beyond the GSEs and be available more broadly. I think the more we're able to lay a foundation that a private securitization market can be built on, the better off we'd be.
If I have a minute here, I'm going to quickly push. Last week, the Treasury Department announced its deliverables for the upcoming strategic and economic dialogue with China. One of the issues a few years back, ownership caps were raised there from 33 to 49%, but this is largely symbolic because it doesn't really provide further benefit to firms operating in China. When Chinese institutions invest in the U.S., they face no ownership cap or activity restrictions. And this is just one of many impediments that our financial services firms face when operating there. I did want to raise with you that issue, and also I raised with you earlier that on this technology restriction, we've got China agreeing to delay implementing a certain restriction on its draft anti-terror laws that would require foreign companies to hand over their encryption keys. Clearly, our banks and our financial services firms, technology firms, cannot operate under those conditions in China. Recently, we were in Shanghai, and they were pushing that. It is still on third reading. The People's Congress is adjourned until next year, but that still hangs out there. And so we need to have greater pushback.
Congressman, I agree with you totally. I have pushed back with China's most senior leaders on this issue and have made it clear to them that it is a very significant issue here, and it's something that in the context of both the EventID and the leaders meeting, we need to see movement on.
Thank you, Chairman.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, ranking member of the Monetary Policy and Trade Subcommittee.
Thank you so much for joining us today, Secretary Lew. I can't resist asking some questions about liquidity as well, since that's come up several times, but I want to take a different approach as opposed to the required capital standards. I was wondering, in your testimony, you mentioned that it's been a year now since we have floated the NAV for institutional investors, and at least your executive summary was not very descriptive of how that's been working. I'm wondering if we have seen less use or about the same of assets which are typically a little bit more liquid than other investments in the money market mutual fund.
Congresswoman, first, the rules I don't believe are effective yet. They were put in final form, but with a future effective date. I think we've seen a continued reduction in the reliance on short-term wholesale funding, which is a good thing. But we still have very large amounts of investment in money market funds. And we saw in the financial crisis that there was run risk there, and the reason that the rules were put in place by the SEC was to create a safer path forward. I certainly will keep an eye on that as it's implemented to make sure it works as designed, but we've made clear that we have to keep attentive to whether or not they are sufficient or whether there's a need for additional policy.
But it would not be a good thing if we were to close down or essentially shut down the money market mutual fund. Or stagnate it in some way, prevent those institutional investors from having that liquidity. That would be something you'd be watching out for.
Right. I mean, the problem is the connection between the money market funds and the rest of the financial system. What we saw during the financial crisis was that the risk of money market investors, institutional investors, leaving, selling their position, was creating the risk that the overnight funding that the largest financial institutions relied on would evaporate, and that could have caused the entire implosion of major financial institutions. We're in a much better place because there's less reliance on wholesale funding, and we now have rules in place to try and make it safe.
Thank you, Secretary Lew. You mentioned also that the threat of migration of servicing from banks to non-banks, such as the recently announced algorithmic lending that Goldman Sachs, for example, wants to do, really demonstrate there's a change in market structure, that there's more risk-taking incentives. I'm wondering, in that context, whether or not, how non-bank SIFIs, do you think it's more important to focus on a few industries, fewer institutions, or what do you see? Do you see an expanded role for the FSOC given the change in the market structure?
Look, I think that we have tried to be very careful and analytic in the approach and not to overreach and go into spaces that we don't need to be in or belong in. The institutions that have been identified are market utilities that have cross-cutting exposures, and the largest kinds of firms that are non-bank firms where the determination was made that the risk is there. So it's not that we're looking to regulate more firms for the sake of regulating more firms. We're going to continue to go through the criteria, and we're obviously getting to smaller firms as we get down the list.
Thank you, Secretary Lew. I was stunned at some of your comments to Mr. Cleaver about GSC reform, and also your declaration in your testimony that negative equity has declined. That hasn't been my experience at all, and I think homeowners are in a lurch after this recession. A lot of housing in my district deteriorating because you can't lend for needed improvements in the home. I mean, basic things like roofs, plumbing, and so on. I think we need some sort of product. I only have 10 seconds, so I guess I just want to get your insight about the health of the homeowner in this environment.
So I'd be happy to follow up. I don't have the time, but I have tried in a few instances to express the concern that creditworthy borrowers should have access to the market, and there are a number of things that we're looking at in that regard.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Florida, Mr. Posey.
Thank you, Mr. Chairman. Mr. Secretary, in October of 2013, the online publication repealfacta.com submitted a Freedom of Information request for documents concerning the intergovernmental agreements with the United Kingdom, Switzerland, and Canada. The Department promptly acknowledged the request and on October 24, 2013, stated that, quote, expedited treatment has been approved. It's a letter from your agency. However, since then, there has been no response from the Department, despite repeated follow-up inquiries from the requester. On January 27th of this year, 15 months after the initial request, I sent you a letter asking for prompt action on the request, and to keep me informed on the response that would be forthcoming. Despite additional inquiries, the only answer I've received so far is, we're working on it. It's now been 20 months, almost 2 years, since their simple initial request under the Freedom of Information Act, and 5 months since my letter inquiring about the status of that request. Is this the Treasury's standard for expedited treatment?
Congressman, in general, our performance on FOIA is better than that. I'm not familiar with a specific matter. I'm happy to look into it.
You know, it's just hard to believe that there's some reason that the department is I'll
have to look into the matter and get back to you.
Stonewalling that one. On another matter, I'd like to bring to your attention the fiscal year 2012 Financial Services Appropriations Bill included report language directing the Secretary of the Treasury to submit a report to Congress regarding the potential risk to the U.S. financial markets and economy posed by financial terrorism and economic warfare. I subsequently met with Treasury Assistant Secretary Fitzpaine in August of 2012 and was told that the Treasury would work on that. The report language also included in fiscal year 13 and 14 appropriations bills. In July of 2013, my staff sent nearly a half dozen emails to the appropriate Treasury staffer for a status update, but those emails went unanswered. Finally, in fiscal year 15 Cromnibus bill, that became public law. The actual bill language was included to the same effect. The Secretary of the Treasury, in consultation with the appropriate agencies, departments, bureaus, and commissions that have expertise in terrorism and complex financial issues, shall provide a report to the Committees on Appropriations at the House of Representatives and the Senate, the Committees on Financial Services at the House of Representatives, and the Committee on Banking, Housing, and Urban Affairs, Senate, not later than 90 days after the date of enactment of this Act on economic warfare and financial terrorism. Obviously, Congress has felt the issue important enough that it has included language in appropriations bill dating back as far as fiscal year 2012. However, it's apparent the Department isn't giving this matter the same attention. I was hoping you could provide us with some information about your progress on the report. Has the Secretary provided this report to the relevant committees in Congress? Given the Department has had knowledge of this issue for over 3 years, I would have thought the Department would have prepared to meet that 90-day threshold set by Congress. And so ultimately the question is, when can we expect the report?
Congressman, I'll have to check on the report, but in the area of economic warfare and terrorism, there's no agency in any government in the world that does a bit more effective job than Treasury, and I'm happy to defend the record that we have here, where really are the global leaders in making progress in this area. And I think it's an area of great bipartisan consensus, and we look forward to working together.
Just doing the report as the law requires would be a great way to kind of boast or toast what you're doing. If you would just...
I'll check on the report. I'm quite familiar with what we're doing. It takes a great deal of my attention and the world's attention. The report I'll have to check on.
So, will you have someone get me in the next week on these two issues about the FOIA request?
We'll get back to you.
So we don't have to wait another 2 years for that one? And let me know the status of this report within the next week? Would that be asking too much?
We'll get back to you.
I heard you say yes a little while ago to somebody on the other side. I was just hoping we could maybe get the word yes twice in one meeting in the 3 hours, but can we expect that maybe in a week?
I don't know what the status of the issues are. We'll get back to you promptly.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Green, ranking member of our Oversight Investigation Subcommittee.
Thank you, Mr. Chairman. I thank the ranking member, and of course, I thank the witness for appearing today. Mr. Secretary, in your annual report, you cite some concerns about cybersecurity. Ironically, on yesterday, the Subcommittee on Oversight and Investigations held a hearing on cybersecurity styled a global perspective on cyber threats. One of the things that we took away, or I did, from this hearing is that there appears to be clear and convincing evidence that cyber threats and attacks pose a clear and present danger to our financial system. And I'm pleased to see that you have addressed this and you need additional assistance pursuant to what I'm reading. You indicate that you would like for Congress to provide the financial regulators with the authority to oversee third-party vendors. And I believe I have some sense of why, but I think that the record should reflect your thoughts on why this is so important.
Congressman, this issue of cybersecurity is obviously a relatively new issue, but it has gone right to the top of the worry list and priority list that we have. And as I talk to CEOs, it's the top issue that many of them have. The challenges are many. It is hard to protect a system. It is hard to have individuals in the system operate in a way that makes it as safe as possible. I think the financial sector is actually at the lead, and we have a lot of work to do in the financial sector. There's many other areas where the exposure is even greater, and some of them overlap. I mentioned earlier the connection between utilities and financial. If your power and phones are not there, it's very hard to run a modern financial institution. I think that it is very much in the mind of both of the regulators and the industry, and the more tools we have to work together, the more tools there are for them to work collaboratively and to share information and best practices, the more likely we are to be successful. A threat that shows up in one place, if you know about it, you can then look for it as opposed to being blindsided by it. And we're making progress. There is much better sharing of information than there was, but I wouldn't suggest that we're ultimately where we need to go. And I think the passage of legislation to enable the greater sharing of information would be very helpful.
I want to concur with you. The witnesses who appeared yesterday all indicated, I believe, that you are at the top of the game, as it were, that you're doing better than most.
I don't take much comfort from that, though.
They didn't say that we have absolute security, and I understand this. My concerns have to do with the need for authority. What would you have us do immediately to give you this authority? I know that it's in broad terms here.
Yeah.
Are there some specifics that you can call to our attention?
Well, the cybersecurity legislation that's pending would take down some of the barriers for sharing of information and collaboration in the private sector. I think getting that in place would be quite helpful. We're doing things now on a voluntary basis where there's risks that firms have to balance, which would be very much eased if the legislation were to pass. We have executive orders that go as far as executive orders can. I'd be happy to follow up with you on more specific issues in the financial space that could be helpful.
Thank you. And finally, this, you have indicated that you believe that you should be allowed to coordinate a national plan, as it were, to deal with these responses to cyber threats. And you'd like to coordinate this with law enforcement, Homeland Security, as well as regulators. How far along are we with this concept of your having this opportunity to coordinate a national plan?
Well, we're obviously, within the federal government, we collaborate quite a lot. DHS plays the lead on cybersecurity, but I'll tell you, in the financial space, we have a regular meeting amongst the agencies that work most closely together, and we're looking at what we can do to be more prepared, and obviously that gives us the ability to reach out more effectively and develop a plan.
Thank you for your service, and I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from South Carolina, Mr. Mulvaney.
Thank you, Chairman. Mr. Lieu, I'm over here. Mr. Lieu, in October of 2013, you went to the Senate Finance Committee and had a hearing concerning prioritization of payments, and you told them at the time that the systems, and I'm quoting, the systems are automated to pay because for 224 years, policy of Congress and every president has been to pay our bills, end quote. You went on to say it would be It wouldn't be easy to pay some things and not others. They weren't designed that way, et cetera. And then in May of 2014, you gave this chairman a letter saying something slightly different. You said, quote, if the debt limit were not raised and assuming Treasury had sufficient cash on hand, the New York Fed systems would be technologically capable of continuing to make principal and interest payments while the Treasury was not making other kinds of payments, end quote. I'll ask you, Mr. Liu, when did you come to learn that New York Fed was technologically capable of making the payments as you set forth in your letter to the chairman of May 2014?
Congressman, I don't remember the exact date, but I can tell you the statement I made at the Senate in October 2013 and the statement to this committee are entirely consistent. What I said in October 2013 is that we make, tens of millions of payments and we don't have the capacity to pick and choose amongst all of them. I didn't address specifically the question of is there the technical capacity to pay principal and interest. I did indicate to this committee that we do have the technical capacity, but it would be a terrible thing to do because if you chose to pay principal and interest, you would be defaulting on something else. You'd be defaulting on a Medicare payment or on a veterans payment or on something else. The only solution is to raise the debt limit and to not put any president in the position where they have to make the decision, do they pay one thing but not another?
Mr. Liu, that was a really good answer the first 4 times I've asked it, or 3 times. I asked you that same question, sir, in May of 2014, and you told me you would have to check. When you came back before us in March of 2015, you told me you had checked, but you had forgotten it, and you didn't remember it on that day, but you would look into it again. I sent you a set of written questions and asked you the exact same question. I got 2 pages with no answer in it. So I'm not going to ask you any more questions, Mr. Liu. I feel like I've given you enough chances to answer that question. My question was very straightforward. When did you know? It's an answer you should know. And if you don't know it, you're right. You should go back and be able to look it up. In fact, you told me one time you did go back and look it up, and you knew it at one point, but you had forgotten before you got here. Mr. Lynch asked you a question, sir, earlier today about whether or not you felt like your answers to this committee were disdainful. And you said that no, you thought that they were reverent. And I kept waiting for the laughter after that, Mr. Liu. I've asked you some really serious questions. We've asked you some really serious questions. By the way, the other questions I asked you, not the first time, go deeper. This is not an empty question, Mr. Liu. This is not a question that we're designed to just gotcha to try and make you look bad so we get on television. That's not the point. We are interested in answering the questions because of the market turmoil that always raises its head as we come up against the debt ceiling. So in addition to the question I asked you about when you knew, I also asked you, I said, in the event we reach the debt limit and exhaust extraordinary measures and Congress does not raise the debt limit, can the Treasury Department continue to make principal and interest payments on the debt? Yes or no? You didn't answer that. You've had, by the way, 6 months to answer these questions. I also, when I asked you, I said, will you commit that in the event we reach the debt limit and exhaust extraordinary measures and Congress does not raise the debt limit, the Treasury will continue to make principal and interest payments on the debt? You didn't answer that either. What are we to imply from your refusal to answer now for 1.5 years these types of questions? That the answers, no, you had your chance. I did what very few people here did today. I let you go until you stopped. In fact, I was going to give you go until I had 1.5 minutes left. You had your chance. My turn. We are interested in asking these questions because we are concerned about what happens in the markets. We would hope that the Secretary of the Treasury of the United States would be just as concerned. Your name is on the money, Mr. Liu. We have given you the chance to calm the markets. You have refused to do so. We have given you the chance to give this committee information. You have refused to do so. The only implication is, number one, you don't want us to know the information we ask for because it's harmful to you or the administration. And the other implication that we are completely within our rights to make is that the answers regarding payments are not being given to us because you want the chaos. Because you think it's preferable to you and your administration, this administration, to have the chaos, that it will help you achieve politically what you want to achieve. So I'm done asking, Mr. Liu. All I'm saying is that when the chaos comes, it will not be on the shoulders of the people on this committee, on either side of the aisle. It will be on you, because you've had the chance to calm the markets and refuse to do so.
Mr. Chairman, may I have
No, sir, not on my time. You can give it to someone else to do it.
The time of the gentleman has expired. The chair now recognizes the gentleman from Minnesota, Mr. Ellison.
I'd like to thank the chair and the ranking member for the time. And I'd actually like to thank you, Mr. Secretary, for answering some of the written questions that I give you. I know that's not easy to do that. You're busy doing a lot of things, but you did give us some answers, and they were answers that we can use, so I want to extend my thanks and appreciation for that. As you know, Mr. Secretary, you're probably going to get a question from me about Somalia. I know you're shocked. And what I'd like to just ask you is, if you have any information on us on the bill that we passed last year into law. There was a bill that we passed last year that was called the Money Remittances Improvement Act, and the goal of the bill was to improve oversight of state licensed non-depository financial institutions. Now that the law is in place, all well-supervised entities like the money services business should have their license status recognized, respected, and I just want to know what you know. And if you don't know anything, I understand, because I didn't tell you I was going to ask you that. But if you do know, I would be happy to get a report.
Congressman, thank you. As we've discussed many times, this issue of remittances is a very important one, and we're very concerned about the problems that families are having in making payments. We're working on the implementation of the legislation, and I'm happy to get back to you with a more detailed response on the status of the implementation. But we're more broadly working on this issue of how to deal with remittances in Somalia.
Right.
You know, as I think you know, we're very involved with the World Bank to develop solutions to the problem, and that really means building up some capacity in the Somali financial system, because right now there's not a real financial system to engage with. You know, we have had meetings at a very senior level in Somalia, at the political level, at the central bank level, and I know that our undersecretary will be traveling to your district to have some meetings on this issue.
Well, I appreciate that, and I just want to say again, I'm foursquare with the administration's effort to stop terrorist financing. I'm on a task force to help achieve that. But at the other hand, we can get so successful at that effort that we close off all the money, and that, I think, would be unfortunate, because it would actually serve the interests of al-Shabaab and terrorists over there to see the collapsing of the Somali economy, which depends upon remittances to the degree of about 40%. So I would like to talk with you more about the implementation of that program. I know that you all are doing some technical assistance to Somalia. I talk with political leaders there and try to give them my best perspective on how they can improve their system. Could you talk a little bit about the work that you all are doing in the technical assistance area, and what sort of message that you'd like them to receive in order to develop that solid banking system that I think they're going to need?
Right. There's not an easy answer to that question. It's hard to exaggerate how little they're starting with in terms of building a functioning financial system. And the tragedy is that there are legitimate transactions like family remittances that should be able to go forward, but it's very hard to know that the money isn't going to go into hands that will do real harm. And trying to figure out how to build that system is why we're working with the World Bank. We can't go into Somalia the way we go into some countries because of the security conditions. So we have people come out of Somalia into other countries for training. It's not the most efficient way to do it. Our OTA people are great when they can go in and work with people side by side. We just can't do that in Somalia. But we're trying to do it off-site to help them build the skills. So it's going to take, it's a process. It's not something you can just kind of hand it over and have a functioning system. They're trying. We're going to work with them, and we have to be creative finding the ways to start that building process.
Well, I just want to urge you, on behalf of the people who live in the 5th Congressional District of Minnesota and many other parts of this country, we're actually, me and Mr. Emmer are going to start a Somali caucus, because we have constituents who live in both districts, and definitely want to see them, see that country get stable and strong and not be a haven or an attractive nuisance for bad people. So we're trying to do our good part, and we hope you will continue to push with that technical assistance.
We will do so, and we'll continue to work with you and try to find a solution to this.
Thank you.
Time of the gentleman has expired. Chair now recognizes the gentleman from Tennessee, Mr. Fincher.
Thank you, Mr. Chairman. Thank you, Mr. Secretary, for being here today. I'm going to go back to an issue you and I talked about a few months ago, liquidity. I know it's been a pretty hot subject today. Recent comments from Larry Summers, former Treasury Secretary under President Clinton and later served as advisor in the White House during the creation of Dodd-Frank. He recently warned regulatory authorities have made a mistake when they looked at each institution and they said, you'll be safer if you withdraw from the markets a bit, and then forgot that if all institutions withdraw from the markets a bit, the markets will be less liquid. The markets themselves will be less safe, and that will, in the end, hurt all of the institutions. I think there is a real issue there. Frankly, a lot of the effort that's going into macro-prudential should be into making sure we have liquidity. What is your reaction to his comments about the role of the regulations, not just Dodd-Frank, but layered capital and liquidity mandates are having on fixed income markets?
Congressman, as I've said in response to several questions today, I think this liquidity issue requires our very serious attention. I think there are a number of factors that have been at work. It ranges from the point we're at in the economic cycle and the volatility that's natural at that point, to the emergence of new market mechanisms that are different and present different risks, to the volume of corporate bond issuance. I have also said that we have our eye on whether or not there are regulatory issues. It's in the FSOC report that it's one of the things we need to look at. So I'm not approaching this from the point of view that we know exactly what it is. Frankly, I don't think anyone knows exactly what the answer is.
But you think it could be a possibility that it could be over-regulation?
But I think the factors that I described, I know are at work. I think that the question of regulation is much more speculative. And I think people have jumped prematurely to a conclusion about regulation, which I think would take our eye off of where the real risks lie.
Would you say that we need more regulation?
Look, I think that we have come a long way since the financial crisis. Our system is safer and sounder. We have the ability for our institutions to withstand a bump in the road that they didn't have before. That doesn't mean that we should ever stop. We have to keep looking forward.
So you think more is needed? Would you?
I didn't say more or less. We can't say that, you can't take 50 years between looking at these questions. That didn't turn out so well. We need to keep our eye on the future, and we have to be open to the possibility that there are multiple different factors that are at the core of an issue. And on something like liquidity, it is of fundamental importance that we have a deep and liquid market here.
Right.
You still have to separate out treasury markets from corporate markets to high-risk markets. They're not all the same. The liquidity issues aren't all the same.
Let me follow up. Summers' comments have been echoed by everyone from the Bank for International Settlements, Bob Ketchum at FINRA, SEC Chairman White, CFTC Commissioners Bowen and Giancarlo, and many overseas regulators such as Mark Carney at the Bank of England. We talked about you issuing a data-driven analysis, and I think you have said there's going to be in a white paper coming out.
Hopefully, our goal is to get it this summer, and we will share it as soon as it's completed.
Okay. Well, it seems like it's every time we have a hearing, we talk about the problems that we face, and more regulation. I know I'm just going to differ with you, and I know you haven't said, but it sounds. I know, but it sounds like that you are inclined to be for more.
We have to be open to less. Also, I didn't say more.
Well, there you go, and that's good. I will.
We have to be open to more or less.
Well, it's what seems to be happening is the more liquid that's tied up in the markets. It's not the bigger institutions that pay the price here. It's the small guys. It's the guys back in states like Tennessee and Arkansas, Mr. Hill, that end up paying the folks at the bottom. And we need to make sure that when something does happen, there is enough liquidity available to take care of these issues. So thank you, Mr. Lieu. And with that, I yield back, Mr. Chairman, which is rare, balance my time.
Thank you. The gentleman yields back. Chair now recognizes the gentleman from Colorado, Mr. Perlmutter.
Thanks, Mr. Chair. Thank you, Mr. Secretary, for staying cool under the withering cross-examination of my Republican colleagues. So I just really have a different view than the chairman, than Mr. Duffy as to what's going on in the economy. We might as well start with all the records being set by Dow Jones. It's up from 6,500 at the end of George Bush to 18,000. This S&P from about 700 to 2,100. The NASDAQ is 3 times what it was. Foreclosures are down, very low. There's been a tremendous improvement across pretty much all sectors, from manufacturing to hotels to whatever. So when they're talking about calming the markets and you're causing them to roil, I want to thank you for rebuilding the markets from the recession that we were in at the end of George Bush. And I don't know if you have your report in front of you, but there are some very important graphs that I'd like you to take a look at if you have your report in front of you. So let's take a look, just as easy ones, starting with 4.1.4. That is just for, under the Obama administration, we see oil imports drop and oil production increased like we haven't seen in decades. Do you see that one?
I do.
How about 4.1.6, civilian unemployment rate dropping like a rock? This is on page 20 of the report. After the 2007-2008 recession. You see that? All right, but now let's talk about FSOC. So if you would turn forward in your report to page 62 and 63. I want to look at graphs 5.3.16 and 5.3.19. See those?
Yep.
So can you tell us what graph 5.3.16 is?
Now you're I've read the words. I'm looking at some of these graphs.
All right, so let me tell you what it is, and then you can expand on it if you like. So as the recession took place starting in 2008, 2007, 2008, we saw loan loss reserves fall, so that banks couldn't withstand more and more losses. But since FSOC was created in 2010, what do you see in terms of the loan loss reserves? They've almost tripled.
Yeah, and we're seeing performing loans doing better, and we're seeing the foreclosure issue settle down.
Okay, now let's look at the one that's really quite telling, and that's 5.3.19, FDIC insured failed institutions. Do you see that?
Yeah.
And my friend, the chairman, was talking about this recovery and why isn't it bigger other than the fact we have 13 million new jobs. We see pensions at all-time high, but under Republican administrations, and I think between 1980 and 1990 we had the Reagan administration and the first George Bush administration. Look at the number of failed institutions. You see that?
I do.
Okay, then it falls off to virtually zero under the Clinton administration. There were no bank failures almost. Do you see that?
Yes.
Then under the second George Bush, we see a tremendous spike in failed institutions. You see that? So now it's fallen off precipitously. We're here to talk about the FSOC and about Dodd-Frank and putting some structure back into the market so that we don't have a failed banking system. Would you like to comment on that?
Congressman, I think that you have talked about the improvement in the economy in a very compelling way. Obviously, the graphs illustrate it, but so does the number of people working every day. I think that there's no doubt, but that the steps we've taken through Wall Street reform and FSOC have made our system safer. We also have an economic recovery underway, which is why everything is also getting better. What I don't think we can do is kind of rest comfortably that there's no problem out there to worry about, because what will happen is we'll get to the down point of a business cycle, there will be stress in the system, and we owe it to the American people to make sure we're in a position when times get tough that we don't go back to the 2007, 2008 kind of situation. That's exactly what we're doing in FSOC.
And I completely agree with you, and that's why you need the loan loss reserves so that you can withstand a downturn. That's why we take into consideration these precautions. That's why
you need capital.
If I were my Republican friends, I'd be grasping at this liquidity straw too, given the overall recovery of the economy. But I want to thank you and I want to thank the President for putting this economy back on track. And I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Florida, Mr. Ross.
Thank you, Mr. Chairman. Mr. Secretary, a pleasure to have you here again. I want to talk about the ultimate goal of FSOC. FSOC's goal is to reduce risk in the markets, is it not?
Yes, it's to reduce, it is to make sure that we have financial stability always on our minds and we reduce the risk of a financial crisis.
And financial stability could be accomplished with the elimination of risk, too, which I don't think that's the ultimate goal, because without risk you have no return, of course. Let's talk
That's why
about...
I focused on stability.
Thank you. And let's talk about stability, because in gaining stability, we need to make sure that our institutions have a proper roadmap. And right now we have a designation of a SIFI that leads to an institution now trying to find out how they get out. And I give you credit for what happened in February with some of the transparency rules that you promulgated, and an opportunity every 5 years to try to get a decertification, if you will, of being a SIFI. My concern is though, why don't we have in place a roadmap, a precautionary measure to prevent them from ever being designated as a SIFI?
You know, the process is not one where we assume that everyone could be a SIFI. I mean, it is to go through the firms that present themselves because of their size, complexity, and structure.
True, but are we not focusing on more of a treatment for the cure instead of giving the prevention of the problem?
You know, I think the reality is that no two firms present themselves in an identical place, and the way we go through the analysis looks at each firm and the risk that it presents through a consistent set of questions.
It should be done that way, but again, in a proactive way, if these firms being looked at were given some guidance to prevent them from ever going over the cliff, we wouldn't have to have the designation. Let me move into something real quickly here on asset managers, because I think asset managers are pretty important, and I've got some concerns about them being declared SIFIs. For example, in Dodd-Frank, it says that some of the criteria to include are leverage, the extent and nature of the off-balance sheet exposure of the companies, the amount and types of liabilities of the company, including the degree of reliance on short-term funding. Let's talk about leverage. What is a leverage ratio that you would consider to be worrisome? 30 to 1?
Yeah, I don't want to give you a single number. Obviously, the larger it is,
so the smaller would be better. Yeah. And knowing that, 5 to 1 may even be a little bit of a concern.
And it depends on what the investments are in.
Correct.
So it's a combination of leverage and risk.
Well, when asset managers will not take, they won't have a greater than 1.5 to 1 risk. In fact, I think Vanguard has 1.04 to 1 risk, which is about almost minuscule. It would seem to me that that should be a consideration that would prevent them from even being considered a SIFI. Would you?
Well, it's certainly a factor that you would have to consider, and we have made our focus for this last period of time looking at the activities that contain the most risk, because we don't.
But they don't really contain risk. Asset managers don't contain risk. I mean, they're basically they don't even have any collateral as such to that risk.
First, asset managers have different business models. Some of them are leveraged, some of them are not leveraged.
But the leverage is very minuscule. Let me just go into this if I can. Once you're a SIFI, then you become jointly and severally liable for all SIFIs, do you not? I mean, if one fails, then everybody that's a SIFI bears the brunt of that?
I'm not sure what you mean by joint and several. I mean,
the SIFIs themselves will bail out the SIFIs.
I'm not sure what you're referring to.
Okay. Let me move on then to what the impact is of if a SIFI, if an asset manager were to be deemed a SIFI. You of course realize the cost of compliance, but most importantly, asset managers deal in mutual funds. They deal in 401ks. They deal in investments that deal with people's retirements and pensions. And there's a study out there by the American Action Forum that indicated that the capital requirements necessary if an asset manager was deemed a SIFI could raise the cost as much as 25%, that over the life of that program, of the retiree, could be over $100,000. Will that not be taken into consideration when trying to determine whether they're a SIFI or not?
Obviously, those same retirees have an interest in making sure that they have access to their savings when they need them, and that they.
But it could have a significant impact on the mom and pop.
I don't start out with the presumption that firms should be or shouldn't be designated. I think we have to complete the analysis and come to a conclusion of what risk factors we're looking at, and if those risk factors warrant any kind of action. So
I agree with you. It's just I think it would be a good preventative measure to do it in conjunction with the institution so that they can prevent that risk from ever being taken and ultimately continue in a very stable financial environment.
My sense is that the asset management industry is very much offering its views as we go through this process.
Very strongly, yes, sir. I see my time is up. I'll yield back.
Chair now recognizes the gentleman from Maryland, Mr. Delaney.
Thank you, Mr. Chairman, and thank you, Mr. Secretary, for being here. I want to associate myself with the comments that Congressman Ross just made, because I have a similar view on asset managers, but I don't want to take up time to talk about that. And when I walked in, I thought I heard my colleague asking you about the prioritization of our debts, but I might not have heard that, and I know you weren't able to answer it, so I do want to make a comment on that. It seems to me that's a really misguided idea, because the best credits in the world, which obviously we should view the United States as certainly one of them, never prioritize their debts, right? Berkshire Hathaway, ExxonMobil, all these terrific credits, all their debts are treated the same, and they have great flexibility as a result. Whereas weak credits are forced by the market to prioritize their debts so that people know exactly what they have and when they get it paid. So it strikes me it would be a really misguided idea to force the United States government into a position where we're somehow signaling to the world that we're a weak credit. I don't know if you agree with that. Very quickly, if you don't mind.
I couldn't agree more. I think that the reality is the technical question of could you pay principal and interest misses the point, which is that if you pick and choose what you pay, you're going to default on something.
And you're going to present very differently than the way we want the United States to.
Even if you reach the conclusion that you had to do that because it would be disastrous not to, it's a terrible place to be because you're still in default. So the only thing that solves the issue is to raise the debt limit.
So the second question is about the liquidity crisis, and I know you've talked about this a lot. And it's interesting when you think about the role of banks, which have been very important to our economy for a long period of time, which is why the government has supported them, which is why we also try to regulate them in ways that make sense. Right now, banks are not all that important when markets are good. There's a lot of other alternatives for liquidity. But they're really, really important when markets are bad, because there's no incentive for market-based participants to really participate in markets when they're bad, other than if they're kind of vulture investors and trying to get really good deals. And I do worry that what's happened with liquidity has put these banks in a position that if there were some kind of a crisis, they wouldn't be able to respond as well. And I know there's a lot of reasons why this liquidity data is emerging, but it seems to me, and this is coming from someone who's supportive of the regulatory response that we've had, supportive of Dodd-Frank. I think all the things we obviously had to do. But it seems to me the notion of having very high minimum liquidity standards for banks, coupled with not looking at risk-weighted assets from a capital test and having this kind of overlay where you still risk-weight assets, but you need a minimum amount of capital, which inevitably puts a lot of capital against really low risk-weight assets like treasuries. It seems to me those create very big incentives for banks not to be liquidity providers in a crisis. Do you agree with that assessment?
I think that the liquidity rules, the theory behind them was you look at the overall exposure of the firm, and they didn't make distinctions between different kinds of assets. I obviously think that treasuries and cash have a degree of safety that's different than almost any other asset in the world. But that's a different approach than saying everything is treated the same.
Would you support changes to the regulatory framework that actually eliminated disincentives for institutions to hold treasuries and cash so that they're actually in a position to do their job in a crisis?
I don't think we have any evidence that they're not in a position to do their job. The treasury markets remain deep and liquid, and as I've said a couple of times today, I don't think that what people looked at on October 15th in terms of the movement on treasuries had to do with a lack of it wasn't the effect of any kind of regulatory environment.
But the people running these institutions seem to think they have a disincentive to hold liquidity in cash.
Yeah.
So sometimes perception becomes reality.
So I'll give you an example. I've heard a lot of them say, as if it affects the treasury market, that Volcker is the reason. But
No, that has nothing to do with it.
Volcker doesn't cover treasuries.
I agree. I'm talking about treasuries.
Yeah, so in treasuries, I think you asked the right question. Is it something in the leverage rules? Because the other rules didn't
Because it used to be, no matter how many treasuries you had, you didn't have to have really capital against them. Now you kind of do. So that, in my mind, if I was running an institution, that would make me have less of them.
Right. I think that it is very important for us to maintain the deep and liquid treasury markets. It is something that is part of what makes our dollar the world's reserve currency. It's part of what is our economic backbone. I don't see a weakness in the treasury market right now, but I can assure you that a day doesn't go by when I don't ask questions about it.
Last question. XM Bank. I've talked about ideas where institutions like XM are required to sell off some of their portfolio on a regular basis so there's better transparency as to how their assets are priced. Do you support approaches like that?
I'm not familiar with that proposal. I'd be happy to look at it. I think the Ex-Im Bank does enormously important work in leveling the playing field for U.S. exporters. It throws off a profit.
And I agree with that position.
Yeah.
I just think additional transparency around how they price their assets is useful.
I just haven't
for
looked at that.
everyone.
I'd be happy to look at it.
Time of the gentleman has expired. The chair wishes to alert members to accommodate the secretary's schedule. We anticipate clearing 3 more members in the queue. Presently, that would be Mr. Stivers, Mr. Pittenger, and Mr. Barr, depending on whether or not somebody else walks in on the Democratic side. The gentleman from Ohio, Mr. Stivers, is now recognized.
Thank you, Mr. Chairman. Right here, Secretary. How are you?
Well, how are you?
Good. So you've already answered questions from Mr. Duffy and Mr. Ross and Mr. Fincher about liquidity. I want to ask a couple things about that. You've said you don't think there's a problem, and to you the world is rainbows and unicorns and everything is good with liquidity. But
I don't think that's what I said.
well, you said there wasn't a problem with liquidity, didn't you?
No, I said I think the Treasury, we haven't seen problems in the Treasury market. I think there are issues about liquidity that require a lot of attention, and I went through at some length the kinds of issues that I think we need to pay attention to.
Great. Okay. Well, then let's talk a little bit about that. So you do believe that we need to give it a little attention. As your role of chair of the FSOC, have you directed the Office of Financial Research to study this problem and how the policies that are completed and proposed might, come together to cause a problem, or have you asked them anything at all? Because some of us would love to see them do a study. I wrote them a letter asking them to do a study, and I'm just curious if you've asked them to do a study on it, on liquidity. And
They are doing work in this area, and they've obviously issued some analysis, and I know they have other work that is ongoing, and I think it's questions that, it's not just an OFR question, it's a question that we have to ask in domestic finance and Treasury, securities and banking regulators have to ask. So I think that there's a serious conversation in this area. What I've tried to make clear is that it would be a mistake to jump to conclusions about what the relationship between the safer, sounder world after financial reform and liquidity is. We have to be open to it, but not assume that that's the whole explanation.
I don't disagree with you, which is why I asked you if you would ask the OFR to do a study, and so you just indicated there's some work going on. When can we expect to see a study from OFR around
I would have
this?
to get back to you on the work stream.
Please do, because that's their job. Their job is, it's called the Office of Financial Research, so it seems to me that they are the most logical place to look at it.
They've been doing a lot of analysis on October 15th, for example, to understand what happened on that day, and they are very much in the space of helping to make it possible to look between the data that different regulators have and do the analysis.
Which is their job, and I'm just asking you to have them do their job and make that available to us, because as policymakers, we'd love to see that, and it may impact some of the policies we decide to make. And as somebody who enforces those policies that are made by Congress, obviously you have some ability to change the way you do your job too. But we would love to see that information, and the sooner we can see it, the sooner we can make an informed decision, as opposed to either one of us, maybe me assuming that it is a problem and you assuming it's not. Let's look at
I couldn't agree more that we have to understand things before we act.
So please ask them to do a study that is detailed with regard to this, because I think, when you see what's going on between the Volcker rule and what's going on with the Department of Labor and what's going on in the private sector separately from regulation, where a lot of people are simplifying their business model, getting out of some risky businesses, those three things come together in a way that could really cause a liquidity crisis in the future. And I just want to make sure we look toward it and try to anticipate it and head it off. So please, I would urge you to do that. The other question I've got real quickly is with regard to designating systemically important institutions. Has anybody talked to you about that? Because I didn't hear whether anybody had talked much to you about that today.
Quite a number of questions earlier.
So
I'm not sure what question.
Okay, do you think the $50 billion let's talk about banks for a second. The $50 billion level, many folks, including folks of the Federal Reserve, have said that is an inadequate and artificial number. How do you feel with that number in the law?
I think that it's important that we use the flexibility we have to treat institutions of different size differently, and we've tried to do that, and we need to continue to ask, is it being done as well as we can do it? I think it's a mistake, though, to think that a $2 billion institution is the same as a $50 billion institution or a $100 or a $500 billion institution. So I think some of the suggestions that I've heard about drawing the line, say, at $500 billion are very bad policy. That would take the next 6 largest institutions out of the heightened supervision.
Let me suggest an alternative approach. Have you looked at non-bank assets, the assets that are not under the covered institution? I'd ask you to look at that because that's where the systemic risk is created. I know my time is gone, but please look at that. I'll follow up in writing.
Time of the gentleman has expired. The chair now recognizes the gentleman from North Carolina, Mr. Pittenger.
Secretary Lew, there's been some discussion today, considerable amount, regarding the debt. From what I understood, you seem to be somewhat dismissive of this concern and of the threat. Do you see it as a threat? You see it as economic?
I spent most of my professional life trying to control our spending and have revenue to cover our expenses, so I don't dismiss it at all. I think we've made enormous progress.
Do you see it as a level of concern as much as Iran?
I don't think...
In terms of national and security and economic security?
I think
how would you place it?
If we had stayed on the course we were on in 2008, I would say that we have made progress since then.
Sir, in due respect, let me ask you, this is a question I'm asking. How do you view the threat? Do you view it as important as a concern that we have with Iran and the security threat there? The economic threat that we have with the debt?
Look,
do you sense that? Is that as compelling to you?
I think they're obviously very different kinds of
They
threats.
are.
We have made a lot more progress on our fiscal position than we have in terms of moving Iran.
I understand that. You heard the statement from Admiral Mullen earlier, and you hear it from Peter Orszag still today, the former budget writer for Mr. Obama, still talking about the trajectory of spending and the concerns with the debt. I was with Erskine Bowles over the weekend. I've known Erskine 25 years. He made a statement publicly this last fall regarding the spending levels and the debt and where that's headed. There's a lot of people who give clear focus on the debt and see it as a major priority and a concern. And what I'm asking you, do you see the same level of concern when you put your head on the pillow at night? Does that keep you awake as much as Al-Qaeda?
Congressman, we have made enormous progress.
No, sir. No, that's not my question, in all due respect.
But it's the reason why my answer is what my answer is. If you had asked me this question in 2009, I would have given you a different answer than I'm giving now.
That's what I'm asking you today. Is it a vital concern to you today?
I don't think it is the most pressing concern today because we have controlled the rate of growth.
So $18 trillion, that's not a concern to you.
As a percentage of GDP, we've stabilized the deficit and the growth of the debt.
And the trajectory of spending is going up,
I think that
not leveling off.
For the next 10 years, we have a stable debt and deficit situation.
Here's Erskine Bowles. Excuse me. Here's Erskine Bowles, October 2014. The deficit is projected to return to an upward path over the rest of the decade and beyond. Sir, a lot of smart people disagree with you. A lot of smart people are concerned about the trajectory of spending and the imploding debt and the fiscal crisis that's going to put us in. And what I'm asking you is, do you not share that concern?
Well, Congressman, I'm telling you, I do have a concern about our fiscal policy. We have to maintain a responsible fiscal policy. We also have to maintain growth, and we have to...
Do you think it's enough to talk about, to bring it?
Well, we've done more than talk, Congressman. We've reduced the deficit.
Sir, in all due respect, the man that you work for, that you report to, has he ever brought it up in inauguration? Has he ever brought it up at State of the Union? He came here to the Capitol this week to talk about TPA. Has he ever come to talk to the members of Congress about the debt and the consequences of the debt?
Congressman, when he took off...
The man that you advised, do you advise him to address this debt concern?
Congressman, we have reduced the deficit as a percentage of GDP from 10% to under 3%. I'm
talking about the future.
That speaks to what we're doing and what we've done.
Well, there's a lot of smart people who precede you in your job who have serious concerns about it. Let me go on to another issue, and that deals with FATF. There's 34 countries, as you know, committed to the 40 recommendations of FATF in going after terrorism financing. What capabilities do we have of going after those countries that are not in compliance? You know, we have Turkey, we have Qatar. Clearly, they're complicit with terrorism financing. What role can you play as enforcer in that FATF is not an enforcer? They merely have the standards. And yet, clearly, we see the infractions by those who, in some measure, would, like Turkey, is a member of NATO.
FATF has been a very important process to bring the world community together behind high standards to control bad practices and bad activity. We are very much engaged on a bilateral basis with any country that we see doing things or not doing things that they need to do to control.
Have you called out Turkey on the matter?
I have talked with our counterparts in Turkey about what they need to do in their banking system.
Have you called out Qatar?
I've talked to people in most of the world about this issue, and when we talk, they actually respond and they move. So it's not an easy process where you can just kind of turn a switch and have everybody doing everything they need to do. But we are engaged very deeply at a very high level around the world.
Thank you for your service. I yield back.
Gentleman yields back. Our last questioner will be the gentleman from Kentucky, Mr. Barr. He's now recognized.
Thank you, Mr. Chairman. Mr. Secretary, thank you for your patience in staying with us here. Since we've talked a lot today about market liquidity, let me bookend our discussion here today with that subject. The Center for Financial Stability has found that market liquidity has declined 46% since its peak in March of 2008, and a recent article in the Wall Street Journal provides this analysis. Talk to almost any banker, investor, or hedge fund manager today, and one topic is likely to dominate the conversation. It is the lack of liquidity in the markets and what this might mean for the world economy and their businesses. Market veterans say that they have never experienced conditions like it. Banks have become so reluctant to make markets that it has become hard to execute large trades, even in the vast foreign exchange and government bond markets, without moving prices. So I want to address my question to your skepticism that regulation has played a part in this liquidity issue. Have you heard from bankers, many of your former colleagues on Wall Street, and bankers that I've heard from as well, that they are less likely today to engage in market-making activities as a result of Volcker and other regulatory pressures?
Look, I have heard people say things, some of which are supported by fact and some of which are not.
But you,
what people say,
clearly as Secretary of Treasury, you have...
I talk to people all the time.
And they've given you that feedback. Yeah. But what is it that leads you to doubt their sincerity, or do you not?
I'm not doubting anyone's sincerity. I think people see the world the way they see it. Sometimes it's right and sometimes it's wrong. I think that, you just cited at the end of the piece that you read, that people are saying they're having trouble moving blocks of bonds in any size they want without any movement of price. I think that that has something to do with market structure. You have different players in the market now. It may mean that to maintain liquidity, you have to do multiple transactions.
Understand, but
it's different from not being able to transact.
Understand, but would you acknowledge that when banks become reluctant to engage in market making, that impacts liquidity?
Yeah, I think there's different kinds of market making going on. If there's a lot of market making going on, and you can't roll back the clock. The fact that you have the emergence of, say, electronic trading and high-frequency trading, there's a lot of activity taking place in that space that isn't the traditional broker-dealer model.
Well, let me take one example, and this is the collateralized loan obligation marketplace. $350 billion of senior secured commercial industrial loans that provide financing for very dynamic job-producing companies, many of which are actually in my own district. Would you acknowledge that the Volcker rule has forced banks to take pretty significant losses in AAA and AA CLO paper?
But obviously, the Volcker rule is still taking effect. It hasn't. There are
already banks being forced to divest AAA and AA CLO paper.
I mean, the banks are going to have to not have proprietary investments, that they had in the past.
Right, but let me ask
you. That means
you,
that they're going to have to sell some assets.
Sir, do you know how many AAA or AA tranches of CLO notes defaulted over the last 20 years? The answer is 0. The Volcker Rule is forcing banks to divest in very safe investments. And you've got to acknowledge that has a destabilizing impact on the financial stability of these institutions.
But I think you also have to acknowledge that the exposure to risk on proprietary investments was a significant
What risk
crisis.
is there with AAA or AA CLO notes that have never defaulted over 20 years and performed well during the financial crisis?
The objective of the Volcker Rule was to reduce the level of risk exposure of firms by getting them out of proprietary investments. I think they will be better off when that's implemented, and I think the markets will adapt.
You don't dispute the fact that Volcker forces banks to divest of AAA paper that hasn't defaulted in 20 years.
With the exception of treasuries, it is a pretty tight rule in terms of...
Let me conclude just real quick with one other point, and that is community banks. Community banks in my district, the bankers tell me that Dodd-Frank and the avalanche of compliance costs and red tape has really impacted their bottom line, and the numbers bear this out. The number of community banks, 10 billion or below, has shrunk from 7,700 in the second quarter of 2010 to only 6,300. Meanwhile, there's consolidation in the industry. So the big banks, the SIFI banks, are larger, and too big to fail is a bigger problem now because we don't have diversity and we don't have competition, as much competition in the system. Can you respond to that financial stability issue?
Look, I think the consolidation was going on before Wall Street reform was enacted, and I'm not sure that consolidation is leading to the SIFIs taking over. It's mostly smaller banks combining, and it's an issue that we have a real shared interest in making sure communities have access to community banks.
And I'd encourage FSOC to look at consolidation, industry consolidation, as a problem because it is exacerbating too big to fail. Thank you. Yield back.
Although there are other members in the queue, they will not be recognized today. I'd like to thank Secretary Lew for his testimony. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for his response. Mr. Secretary, we would ask that your office respond as promptly as you are able, and I mean this most respectfully and sincerely. We would ask that Treasury would cease the response dump at midnight before your appearances. That is a sincere request to you, sir. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing stands adjourned.